Hi candidates, welcome to another session of manifested online classes. So we are still continuing with the topic number 1. In this session, I want us to look on one of the subtopic, which is regarding recognition and measurement of impairment losses in accordance with the International Accounting Standard number 36. So in this topic, you're going to discuss a number of issues. One, we are going to define what is impairment. Then from there, we look on how impairment is measured and also recognized in accordance with IS 36. We look on some of the factors which may indicate that an asset could be impaired and therefore requiring an entity to carry out impairment review. And then later on, we are going to look on the determination of impairment losses as far as the cash generating unit are concerned. So, but to start with, we need to define what is impairment. And generally, when talk about impairment, this refers to the reduction in the value of an asset such that the recoverable amount of an asset is less than the carrying amount, meaning that once the recoverable amount of an asset reduces below the carrying amount, then in such a case, we say the asset is what? Impaired. When talk about the recoverable amount, this is the amount now which can be recovered by the entity as a result of selling the asset currently or as a result of continuing to use the asset, in which case now the asset will generate some cash flows and basically the carrying amount. So if that recoverable amount is less than the carrying amount, then we say that the asset is what is impaired. So therefore, we can start by defining what is impairment of an asset, and we can say that this is a reduction in the value of an asset such that the recoverable amount is now less than carrying amount, is now less than the carrying amount. So therefore, impairment is whereby the value of the asset will reduce such that the recoverable amount it will be less than the carrying amount. So generally, therefore, what is important for you to know is that an asset will be said to be impaired if the recoverable amount of an asset, is less than the carrying amount. So in this case, we have these two terms here which we need to know their meaning, or basically which we need to define. We can start by defining the term carrying amount. So the carrying amount, in other terms, this we refer to it as the net book value, and basically this is the value at which an asset is recorded in the company statement of financial position. In terms of how we determine the carrying amount or the net book value, we take the cost of the asset and then we less the accumulated depreciation. But let's define what is the carrying amount. We have said that this is the value of an asset in the statement of financial position, and you are saying it is the same with the net book value. So meaning that the carrying amount abbreviated as CA or net book value abbreviated as NBV is equal to the cost minus the accumulated depreciation. So that is the definition of the carrying amount, and equally the determination of the same. So the other term which we have here is the recoverable amount. And for the recoverable amount, this is defined under IS 36 to be the higher of two values, to be the higher of the value in use and something known as the net realizable value or the fair value less cost to sell. So we can say that this is the higher, this is the higher of two values. So number one, we have the net realizable value, net realizable value. It is also known as the fair value less cost to sell, fair value less cost to sell. So therefore, the net realizable value or the fair value less cost to sell, this is the amount at which an asset can be sold at currently, and then we less any cost which will be incurred by the company in order to sell that asset. For example, for the company to be able to sell an asset, the company may be required to place an advert in the newspaper to be able to get a buyer. So that cost, any cost which will be incurred by the company for the company to be able to sell that particular asset, we refer to sell. So we take the higher of that, or number two, something known as the value in use, value in use. So in this case, when we talk about the value in use of an asset, this is the present value of the expected cash flows to be generated from continued use of the asset, use of an asset from its disposal, So that's how we determine the value in use. So we discount, or we get the present value of the cash flows to be generated from the continued use of the asset and also from its disposal. So once you have these two values, for you to get the recoverable amount, you take the value which is higher than the other. And once you have the two values, that is the carrying amount and the recoverable amount, you just need to compare them. And if now this recoverable amount is less than the carrying amount, then in this case we are saying the asset will be considered to be impaired. And therefore what IS 36 requires is that once the asset is impaired or the recoverable amount is less than the carrying amount, the company or the entity should go ahead and basically recognize something called the impairment loss. So how is the impairment loss therefore determined? So the impairment loss, this one is equal to the carrying amount minus the recoverable amount, abbreviated as what? As RA. So therefore, that is the first thing you need to know here, that impairment of the asset we are saying is that particular reduction in the value of the asset such that now the recoverable amount of the asset is less than the carrying amount. And basically, you have said that the carrying amount of the asset is the same with the net book value. And then the recoverable amount is the higher of two values, the value in use and also what referred as what? The value in use and the net realizable value. So next, let's look on the recognition and also the measurement of impairment loss. Recognition and measurement of impairment loss. Impairment loss. So first of all, we talk about the measurement. We are talking of how the impairment loss should be determined, and that is something we have mentioned here, that impairment loss actually is recognized or is determined by taking the carrying amount minus the recoverable amount. But equally, you have to remember here that when we talk about the recoverable amount of an asset, basically we have said that this is always taken to be the higher of two values. Number one, the net realizable value, or number two, what you refer as the value in in use. The value in use. And the difference between carrying amount and the recoverable amount is the impairment what? Loss. Now, it is also important for me to mention here that IS 36 requires the entity to recognize an impairment loss whereby the recoverable amount of an asset is found to be what? To be less than the carrying what? Amount. Maybe you can just mention that here, that impairment loss is recognized when the recoverable amount of an asset is less than the carrying amount, which is the CA, abbreviated as what? The CA. And in this case, you have said that the amount of impairment loss always will be equal to the carrying amount minus the recoverable amount. Now, this particular impairment loss, which has been determined, how is it then accounted for by the company? How is it accounted for? So this particular impairment loss, or the accounting treatment of this particular impairment loss, depend with the model which is used by the company, or the accounting model used by the company as permitted under IS 16. So if you can be able to recall what you covered in the lower level, you are told that whenever the company has acquired a number of items of PP, items of property, plant, and equipment, those items should be accounted for in accordance with International Accounting Standard number 16. And that standard IS 16 permit the company to use two models, the cost model and the revaluation model, when accounting for those particular items of what? Of PP. So therefore, in terms of how we account for this impairment loss, it depends with whether the asset is accounted for in what? A model. So therefore, here we can say that impairment loss, or basically we can say accounting for impairment loss depends on whether the asset is carried at historical cost or the revalued amount. So in this case, when we talk about the asset being carried at historical cost or revalued amount, this means that in terms of how we account for the impairment loss, this will always depend with whether an asset in the statement of financial position is recorded at the historical cost or basically at the revalued what? At the revalued amount. So first of all, we say that for the assets carried, or we can have this as Roman 1, for assets carried at historical cost. So these are those particular assets which are accounted for by the company using the cost model. So mean that this particular asset in the balance sheet, they are recorded there at what? At the cost, and then they are what? Depreciated. So any impairment loss arising from or arising in relation to such asset, the full amount is recognized as an expense in the income statement. And then also what International Accounting Standard, that International Accounting Standard number 36 requires is that anytime the asset is impaired, then its carrying amount should be reduced to an amount equal to the recoverable amount. So therefore, for the asset carried at historical cost, we can say the full amount of impairment loss is recognized as an expense in the income statement. And how do we account for that particular impairment loss? We debit it in the income statement by debiting that impairment loss in the income statement, it means that we are accounting for that as an expense, and specifically, that impairment loss should be included as part of the administrative expenses. And then what we do, we credit now the asset account. So, and the reason why we credit the asset account is to reduce the carrying amount of that particular asset to an amount equivalent to the recoverable amount. So that's how we account for the impairment loss for those particular assets which are carried at historical cost. Number two, we have those particular assets which are carried at revalued amount. So we say for the assets carried at a revalued amount, So how do we account for the impairment loss? So let's assume that we have an asset which is carried at revalued amount, and an impairment loss is determined as far as that asset is concerned, and maybe assuming the impairment loss is something like 10 million. And because this particular asset is carried at revalued amount, it means that the asset was previously revalued, and therefore let's assume that a revaluation reserve, or basically a revaluation surplus which was recognized in relation to this particular asset, maybe was an amount of how much? 8 million. So therefore, how do we account for that particular impairment loss of 10 million? So first of all, we say that an impairment loss which is equal to the revaluation reserve will be charged in the revaluation reserve account. So our impairment loss is 10 million. So therefore, impairment loss which is equal to this will be 8 million. So the impairment loss equal to the revaluation reserve is 8 million. And then the difference, which is 2 million, we refer to this as excess impairment loss. Excess impairment what? Loss. So the impairment loss equal to 8 million, we are saying that that one should be charged in the revaluation reserve account, whereas now the excess impairment loss, that is now what we charge in the in the income statement. So therefore, for assets which are carried at revalued amount, impairment loss equal to revaluation surplus, is charged in a revaluation reserve account, while the excess impairment loss, is recognized as an expense, in the income statement. In the income statement. I've given a small illustration there where we have said we assume we have an asset which is carried at revalued amount, meaning that that asset was previously revalued, and maybe the revaluation reserve or the revaluation surplus arising from revaluation of that asset was what? Was 8 million. And during the current financial year, an impairment review has been carried out, and the asset is found to be impaired with 10 million, which now will be the difference between carrying amount and what? The recoverable amount. So what you have said is that in terms of how we account for this impairment loss of 10 million, an amount of 8 million will be charged in the revaluation reserve account, whereas now an impairment loss equal to 2 million, which is now excess impairment loss, that is now what we take to the income statement. And therefore, the accounting entry for this impairment loss is that impairment loss of 8 million, this one will be debited in the account which is called the revaluation reserve account. The excess amount or the excess impairment loss of 2 million, this one will be taken to the income statement as an expense, specifically administrative expense, and then the full amount of impairment loss, which is 10 million, this one will be credited in the asset account. And I've said that the reason why we credit the asset account is to reduce the carrying amount of the asset to an amount equal to recoverable amount. So that's how we account for any impairment loss. And in this case, you can see that in terms of how we account for this particular impairment loss depend with the model, the accounting model used by the company to account for the items of what? PP. Whether the company is using the cost model or the revaluation what? Model. It is also important here to note that according to this particular standard, IS 36, an entity is required to carry out an impairment review at the end of each financial year if there is some evidence which shows that the asset could be impaired. And therefore, IS 36 has gone further to outline some of the factors which could indicate that the asset could be what? Could be impaired. So therefore, next, I want us to look on those particular factors. So we refer to them as indicators of impairment. Indicators of impairment, which we are saying are those factors which indicate that the asset could be impaired. And these factors are classified into two categories. We can start with the internal indicators of impairment. So the internal indicators, generally, we can say that these are those particular factors which shows that the asset could be impaired and which are within the control of the organization, which are within the control of the entity. So which are those particular factors? One is evidence of obsolescence of the asset. Evidence of the obsolescence of what? Of the asset. When we talk about the asset becoming obsolete, basically this means that the asset is no longer needed in an entity. Maybe, for example, the production capacity of an asset is too low, and therefore such an asset cannot be used in what? In an organization. Number two is what referred as the physical damage of an asset. Physical damage of an asset. If, for instance, the company buy a motor vehicle and that motor vehicle is involved in a road accident and therefore it is physically damaged, that is also another indicator or another factor which could show that the asset may be impaired and therefore requiring a company to carry out impairment what? Review. Number three is the asset becoming idle. The asset becoming idle. The asset is no longer used in the organization or in the entity. Number four is where the performance of an asset, performance of an asset being worse, worse than what was previously expected. Maybe the company had acquired an asset and the company had some expectation regarding the performance of that asset, but now the asset is performing worse than what was initially anticipated. So that is the other factor which should shows that the asset could be impaired. So the other one is the plan, a plan to do what? To dispose. A plan to dispose of an asset. To dispose is basically to sell an asset. Plan to dispose or sell an asset before the previously expected date. Before the previously expected what? Date. The other factor which shows that the asset could also be impaired is the plan to discontinue. Plan to do what? To discontinue. Discontinue the operation. To discontinue the operation to which the asset belong. To which the asset belong. So for example, in this case, a company may be producing some product which are meant for export, but the company intend to stop exporting such a product. What that means is that there are some plans to discontinue the operation to which the asset do what? Belong. So therefore, if any of these particular factor exists, any of this particular factor or any of these factor exists, then it basically means that the asset could be what? Could be impaired. And therefore, what IS 36 requires is that such an organization, such an entity should proceed, carry out impairment review by comparing the two values, the recoverable amount of the asset and the carrying amount, in which case, if the recoverable amount is found to be less than the carrying amount, then the organization should proceed, the entity should proceed and recognize what? The impairment loss. So then let's proceed and look on external factors which could show that the asset is impaired. So external indicators of impairment. So external indicators are those particular factors which shows that the asset could be impaired and which are not within the control of the entity, One of it is a carrying amount of entities' net assets, exceeding market capitalization. So the other external indicator of impairment is what you refer as a increase in market interest rate, which affect the discount rate, and thus reducing the value in use, in use of an asset. So the other external factor which could show that the asset is impaired is a significant changes in the technological, legal, or economic environment with the adverse effect. Basically, when we talk about adverse here, we are talking of unfavorable effect on the entity. And number 4 is observable evidence that the value of the asset, observable evidence that the value of an asset has reduced during the current period. So all these are external factors which could indicate or which could show that the asset may be impaired. And therefore, what you have said is that International Accounting Standard number 36 requires that anytime any of these particular factor exists, an organization or basically an entity has to carry out now the impairment review and basically determine whether the asset is impaired. So therefore, it is important for you to note those particular factors. You may come across a question whereby the examiner is requiring you to do what? To outline those particular factors which could indicate that the asset may be impaired. So I want us to look on an illustration question as far as the computation of impairment is concerned. Determination of impairment loss is concerned. And this is a question which was tested in the sitting of November 2020. So specifically question number 1C. So we go through that question and then we see what was required. So this is a question for November 2020. Question number 1C. Question 1C. So the question reads, ABC Limited own a machine which originally cost shillings 10 million. The accumulated depreciation associated with the machine was shillings 2.5 million as at 31st of December 2019. A mechanical engineer assessed the machine in early January 2020 of 2020. The engineer's report stated that similar damaged machine had sold for shillings 1 million in the recent past. In addition, due to the machine unique nature, significant advertising cost of shillings 100,000 would be incurred to find the buyer. The machine was not covered by insurance. In the other paragraph, we are told a power surge during the year ended 31st of December 2019 reduced the machine production capacity and shortened its expected life. ABC Limited management accountant estimated that the damaged machine would generate cash flows of shillings 3 million per annum over the expected remaining useful life of 3 years. And then you're told ABC Limited cost of capital is 9%. And then you're told no impairment loss or no impairment on the of the machine had been recorded in the accounts. So we are required, in context of International Accounting Standard number 36, which governs the impairment of asset, outline the necessary accounting treatment of the machine given the information above. And then you're told note the present value of the present value interest factor of annuity of shillings 1 per year at the rate of 9% for 3 years is 2.5313. And basically the examiner there had given a 4 marks. So if you check on what was required here is we outline the accounting treatment of the machine given the above what information. So the first information which is important to us from this particular question is what you're given in paragraph 2 of that question, that there was a power surge, and that power surge reduced the machine production what capacity. So basically what that means is that at the end of the year 2019, there was some evidence which showed that the machine could be impaired. And therefore, as a result of that, and also in accordance with the International Accounting Standard number 36, this company will have to carry out or must carry out the impairment what review by comparing the two values, the carrying amount of the asset and the recoverable amount, in order to determine whether this particular machine is what is impaired. So therefore, this was the expected solution. We say that on 31st of December 2019, ABC Limited was required to do what? Required to carry out impairment review in accordance with the International Accounting Standard number 36, since there was evidence that the machine could be impaired. Could be impaired. So that is the first thing which was expected of you. You say that at the end of 2019, this company had to carry out impairment review in accordance with International Accounting Standard number 36, simply because there existed some evidence which showed that the machine owned by this company was impaired. And we have said this evidence is that reduction in machine production what capacity, or basically the performance of the machine being worse than what was expected. So whenever the company is carrying out the impairment review, the company is expected to compare two values, the recoverable amount and what the carrying amount. So therefore, as far as this machine is concerned, we need to determine those two values, the carrying amount and also the recoverable amount, and then we check whether the recoverable amount is less than the carrying amount. If that is the case, then we have to proceed and we determine what? The impairment loss. So therefore, this impairment loss on this machine will be determined on 31st of December 2019. It is important for you to have the formula for determining the impairment loss or computing the impairment loss, and this is computed by taking the carrying amount minus the recoverable amount. So let's start by determining this carrying amount. The same with the asset net book value, and this is equal to the cost minus the accumulated depreciation. This information is given to us in paragraph 1. We are told that the cost of this machine was 10 million. The accumulated depreciation was what? Was 2.5 million. 2.5. So that means that the carrying amount, the net book value of this machine at the end of 2019 was how much? Was 7.5. So we already have that carrying amount. So next, we determine the recoverable amount. So let's have that here. And the recoverable amount, this one we said, is the higher of two values. Number one, the net realizable value, which is also the same with the fair value, less cost to sell. So this we said is the value at which an asset can be sold at currently, and then we less any cost which will be incurred in selling that asset. There is some information we are given which will help us in terms of computing this. In the first paragraph, sentence 2, we are told a mechanical engineer assessed the machine in early January of 2020, and then you're told the engineer's report stated that a similar damaged machine, remember our machine here was damaged as a result of that power surge. So we are told engineer's report stated that a similar damaged machine had sold for shillings 1 million. So mean that if the company decide to sell this particular machine which has been damaged by the power surge, the company will be able to sell it currently at 1 million. That 1 million is the fair value, the current market value of the asset. And then to that, we are going to do what? To less any cost which will be incurred in selling that asset. And we are told, in addition, due to the machine unique nature, significant advertising of shillings 100,000 would be incurred to find a seller. To find a buyer. For the company to be able to get a buyer of this machine, the company will need to advertise, to put an advert, maybe in the media, costing 100,000. That is now the cost to sell. So meaning that the net realizable value of this machine is 900,000. So we have that. Then next, we determine the value in use. Remember, we have said the recoverable amount is the higher of these two values. So how do we determine the value in use? This is equal to the present value of the expected cash flows to be generated from the continued use of the asset and also from its disposal. Equally, there is some information with which you are given as far as this is concerned. In paragraph 2, sentence number 2, we are told the ABC Limited Management Accountant estimated that a damaged machine would generate cash flows of 3 million per annum over an expected remaining useful life of 3 years. So therefore, to determine the value in use, what we just need to do is to get the present value of those particular estimated cash flows. And to do that, we take now the estimated cash flows of 3 million, and you're told that this is the annual cash flows. This is an annuity. So this is the cash flow to be generated per annum over the next 3 years. So to discount this, to get the present value of this, we multiply this with the present value interest factor of annuity, and you are given the company's cost of capital, which is 9% for 3 years. And if you go to where we have the requirement, we are given a note there, and you're told the present value interest factor of annuity of shillings 1 per annum at 9% for 3 years is 2.5313. So already we are given this particular figure as 2.5313. So we need to multiply that with 3 million, and automatically that will give us now our what? Our value in use. So therefore, let's get the value in use here, which will be 3 million times 2.5313, and that will give us shillings 7,593,900. So that is now the value in use. So having the value in use, finally what we need to do is we need to determine the recoverable amount. And the recoverable amount, we take the higher of these two values, the higher of those two values. So therefore you can say the recoverable amount of this machine is this one. So this one is the one which is higher than that, is the shillings 7,593,900. So that is the recoverable amount. So what we need to do then next is we check whether our machine is impaired or not. Remember what you have said is that an asset is said to be impaired whereby the recoverable amount is less than the carrying amount. So already we have the recoverable amount here, which is 7,593,900, which is now our recoverable amount. What about the carrying amount? Carrying amount is 7.5 million. 7.5 million. So what we need to do is basically to check is this recoverable amount, is our recoverable amount, this one, is it less than the carrying amount? Is this less than this one? No. So this one is the one which is less than this one. So therefore the recoverable amount is not less than the carrying amount. Which conclusion then do we make? The conclusion here is that this machine is not what? Impaired. Why? Simply because the recoverable amount is not less than carrying amount. So therefore that is the answer here. We say that the machine is not impaired, since the recoverable amount, that is RA, is not less than carrying amount. Is not less than carrying amount. That is CA is not less than carrying amount, and that means that no impairment loss which will be recognized simply because our asset is not what? Is not impaired. So therefore that is it. That what was it required as far as that question was concerned, and basically by doing that, then you were to get how many marks? 4 marks. So therefore we stop at that point. Once we come back in our next session, we are going to look on how we determine the impairment loss in relation to the cash generating unit, and equally how do we go ahead and allocate that particular impairment loss as far as the cash generating unit is concerned. So see you in the next session.
Okay, so for the sake of recording, let me just do this again very quickly. So we've said to do this, we started by go to insert pivot table, and by default it will select the range where the information will come from. And we've said by default again it will create that pivot table on a new worksheet, and your data will be somewhere, or there will be this new area on the right-hand side where the different fields of your data are displayed. Okay, this is where the data is coming from, and we've said you can arrange it in columns, values. Values would usually be those you can either count or sum or get things to do with average. So in values is where you're doing some kind of calculations. It will display some numbers. Columns will be column titles and rows will be row titles. So we have said you can, like for our data here for customers, we said we could analyze it by country. Like we want to know how many of each gender. So if we pick gender, if you do this, it ends up breaking it down. Like in Argentina, there was only female, but a better arrangement is to have one of them as columns. Then, because we want to count, I can use any field, but let me use gender again, because we want to count the number of each gender, right? But just to experiment, just before we do the experiment, quickly, for the sake of those who will be viewing the recording, we've said the data is summarized in these columns, 3 columns. And we've said here you'll see the grand total. Yeah, so you can make some conclusions based on this. We've said from this we can see most of our customers are from the US, followed by Brazil and so forth. But the data also shows us that we have more female customers than male customers. So that might inform some decisions that we make about marketing and so forth, right? And we can also dice or look at this data by city, okay? And you can also switch this. Suppose you wanted the gender to be, it would make more sense the way we have it now. We can also have it looking like this. We put the countries on the rows. Okay, so you can choose to view it in a horizontal layout. Okay, so that was just a quick recap. So let's go to this orders data. We have some orders here, so we have to kind of examine our worksheet to see what information we can get from it. So let's try to analyze this data by orders. We want to know what was the total for each type of order. So we again follow the same procedure. Insert pivot table, select the data for us. Then we have said what we want is the order category. We could make that our column. Let's make it our column. Then we want to know the total cost by order category. Okay, so if you look at that, there were 3 types of orders: large orders, normal orders, small orders. Large orders accounted for 55,485. Normal orders accounted for 12,885. Small orders were the rest. Okay, and you can change these titles to be more meaningful. So we can say, let's say cost by order category, cost category. Okay, cool. What happened there? Cost. For some reason, I think this cell is protected. I need to unprotect it so that it will accept my editing. All right, but the point is you can change the labels sometimes. You can change the labels to reflect what you want them to say. So sum of total costs. Let's try the average. Let's see if we can change this to average. So this is total cost. Or even before we go to average, suppose we put this here and we want to try quantity this time as the value. Okay, so we have each order type and the quantities it accounted for. So there was a total quantity of 7712. Then each of those can be broken down into this. I want to see if we can use something else apart from the order category. Let's get rid of the order category and try to do the product. Okay, so is that. So we have this ordered by the product. So product 1 had a quantity of 865, product 2, and so forth. This is by product. We can also change these to numbers. Suppose we wanted to just count the number for each product. Notice that this time round I have just used product twice. So it is showing me there were 57 orders for product 1, there were 46 orders for product 5, and so forth. So like we said again, pivot tables allow you to view the same data in multiple dimensions. So it is just that worksheet, but we are able to think about all sorts of questions based on that data. We can talk about what was the total quantity of by product, what was the total cost to buy product, and so forth. But let's see if we can also combine more than one parameter. So we can have products as product number as the row. Then let's see how this would affect it. Go to order category and make this columns. Look at that. It adds a dimension to our analysis. Okay. There were 32 large orders for product 1. There were 11 small orders for that product. So we can tell now, we can use this data again to tell which products are popular, like there are larger orders for which products have the largest orders. So like if we look at this, I think 32 was the largest quantity for product 1 and product 6. But in all cases, they're generally larger orders than smaller orders. But I guess in some different data, you might have, there are certain products where there are more smaller orders than larger orders and so forth. But in this case, it is nicely distributed. Most orders are large orders, followed by normal orders, and followed by small orders. Okay. So we can also switch. We can also switch our order categories. Or rather, let's try and switch this. All right, so it looks like that. We can display it in a horizontal format. All right, so that in a nutshell is what you can do with a pivot table. Okay, excuse me just for a bit. Right, apologies for that. Let's go back to this. So I hope it is making sense so far. It's a pretty straightforward concept, and it just helps you view your data in many new interesting ways. So it's quite a useful function in Excel. So let's try with a different set of data. Let me get rid of this. Okay, so that was for orders. Let's go to these products and see. This one doesn't have much data. If I could try this, let me see. This is a customer and this is their phone number. Let's see if there's any way we can analyze this using a pivot table. Suppose I did this. and have the customer as the rows and phone number. Okay, all of them have a single phone number, so this data doesn't tell me much. This one will just list the ones across. Okay, so with this data, you can't, a pivot table would not be very meaningful. It won't make much of a difference because each customer has a single phone number. Okay, so let's look at any other. Okay, I think the only place where it is meaningful is with this data. So these are the orders. Let's try you working with order with ID 10,001 has 176 orders. Let's see how many orders in total there were. This is a lot of data. So if I did a count of this, equals count, let's try to see if this makes sense. Go all the way up. So in total there are 500. So why I'm looking there is I'm trying to understand what this number means. But I see it might not be a meaningful number because they're just adding the order numbers. It might not be a meaningful number. So what I might want to do is, instead of sum of order, I want to know the number of, this is count. I wanted to see if I could count how many orders each customer made. How many orders each customer made. Let's go back to that. I think that is the one we had talked about, the quantity. If I sort this by customer. All right. So what I want to do is to see this. I want to count how many times the customer made some orders. So for 10,002, I should be seeing 3. For this 10,003, I should see number 5 and so forth. So in other words, I want to count. So let's see if we can find a way of doing that. So they should be on these values is where we want a count instead of so we want to, let's see, filter. Okay, this is what I'm looking for. Again, customer. And what I wanted to tell me is how many times when 1 appears, how many times 2 appears. So this is just a list of all the customers. Here I want to see the count. So let me go back here and try to figure it out. So what will I count? I thought this made sense to count this, but instead it is giving me the same value. So there should be somewhere here where I can change this to account instead. All right, let's say I will look this up, but there should be somewhere here where I can change this. Instead of summing, I want to do account. Oh, I think I might just have gotten what I was looking for. Yeah, so the point is you can change this. There you go. What I've done here is double clicked this, then gone, actually not double clicking, then I've gone to the value field settings. This is what I was trying to find. I knew it was somewhere, but wasn't remembering exactly where. But as we have realized, you right click on that or double click, gives you that, this pops up. Then you can do different types of analysis. So the count makes the most sense here. There were 3 orders by customer number 10,002. There was 5 orders and so forth. So let's try and play around with that for a different thing. So if we want to, let me return this to where it was. This was here and get rid. So here, what you have here is the same data, but there's some subtotals. So large orders are this, then it is broken down like that. Then normal orders, the total is this, then it is broken down to what makes up that number, which is one way to look at the same data. But let me get rid of this from here. Think of other ways I can do this. I can change this to the total cost. Instead of having count, I have total cost. So I can do an average this time round, the average cost of product 1. Let's see if that makes sense. Okay, looking at our data, what does that number mean? So I have lots of product 8s. So there was different orders for product 8. So there was order number 176. The total cost for that order was this. The total cost for this was 72. So if you sort by this field, again, it's trying to make sense of the data. If I sort by this field, I can tell there were all these orders for product 1. There are quite a number of them. They go all the way to what? There were 58 orders for product 1. And an average order, so if I go back to my worksheet here, I can say an average order for product 1 was for 273, it could be dollars. So those people who ordered for product 1 ordered an average of products worth 273. So the data in that case makes some sense. That is why we were saying the initial functions and formulas we use were pretty straightforward, but the ones that we do as we get to do more advanced things require a lot of interpretation, a lot of thinking, a lot of understanding the concept, the context. What am I trying to get out of this data? Okay, so the average total cost is that. And I can also change this. Let's change this to by what? By order category. Let's see what that would mean. Order category, or even quarters. Okay, so in total in quarter 1, there was an average order. The average order value or average order in quarter 1 was around 148. The value of an average order in quarter 2 was 132. So generally, it seems like people ordered more things in quarter 1 and in quarter 2. Okay, and even change this to quantity. Let's make this quantity and see which quarter had more. So we have, there were more orders in which quarter? There were actually more orders in quarter 3 and 4, but generally there were the average cost of an order in quarter 1 and 4 were the largest. Okay, so if I remove this here, let's remove this from here so it doesn't confuse us. So this one is purely by the number of orders. People ordered more things in quarter 3 and 4. Okay, which is, it just tells us the number of orders. But if we look at the actual value of those orders, it kind of changes our perspective completely. Because here we might think, there were more orders, there was more revenue, which is not the case. there were probably more orders for lower category things. So let's try putting this here in columns and see. So in Q1, there was, in all cases, there was more orders for the larger, what is categorized as large orders. But let's see the difference, whether the things change in the second quarter, in this column, does the order change? So here, Q1, Q3 was the highest, followed by Q4. For normal orders, Q4 was the highest, followed by Q1. So the point is, once we see this data, when this one was not here, when we look at it, we can reach conclusions sometimes which are not realistic. This is just based on the number of orders. But when we look at how much value each of those orders is worth, then it adds some angle to our analysis. We are able to make more sense of what this means for us as a business. It does not mean there is more revenue, it just means there are more orders, but they could be smaller quantity orders, smaller value orders. So, interesting stuff there. So we've categorized things by quarters. Let's see if there's any other way we can categorize. Let's see what this years means here. Okay, again, even by year makes sense, because it looks like the orders were the period starting from 2010 to 2015. So if I remove this, so this is a quantity ordered by year. So we have in 2010, we have 1129. We can look to see if there is a trend. Is there any trend? Did the orders become more over the years? And we can look at a number like this 2014 and ask ourselves what might have happened there. There was clearly a dip. There was an upward trend, then something seems to have happened in 2014. Then the orders picked up again. Okay. Let's try this time round. So quantities. Let me do total cost. Let's see whether it reflects the same trend as the quantity. So the costs, again, went up steadily through to 2013, but they also dipped. The value of the orders dipped in 2014. So that kind of matches the quantity. And you can think of this data in multiple different ways. Yeah. So what I will do is, I don't want to dwell too much on it, but the point is I was trying to get you to see that it is the same data, but you can analyze it in look at it from very different angles. So depending on the context, you can get all sorts of summaries from the data.
Greetings and welcome to the lesson. In today's lesson, going to learn two things. One is in relation to the adjusted present value and capital rationing. We're still on the first chapter. So we are on the impact of financing on investment decisions. Impact of financing on investment decisions. Impact of financing. Impact of financing on investment decisions. in studying the impact of financing on investment decisions, we limit our discussion on the concept of the adjusted present value. Adjusted present value, the adjusted present value. Now, before that, candidates, it's important to understand the impact of financing on investment decisions, because we all know that financing choices play a key role in shaping investment decisions, because the availability, the cost, and even the structure of financing can significantly influence which projects are visible, which projects are feasible, and attractive to pursue. So the concept of the adjusted present value helps us understand the relationship between financing and investing by explicitly recognizing the value implications of different financing choices. So what is APV? Now, APV is evaluation method that assesses the financial worth of a project or investment by considering both its operational cash flows and the impact of its financing structure. So it separates the value of the project itself, which we call the unlevered value, from the value created or destroyed by its financing decisions. So the APV has various components. The one I've just mentioned is the unlevered value. The unlevered value, which is the value of the project, assuming that is financed entirely by equity. You assume there is no debt at all, and is calculated by just discounting the project's expected cash flows using the unlevered cost of equity, which reflects the required rate of return of the all equity investment with similar risk. Kindness, I'm getting somewhere. And please pay attention. Pay attention. We are discussing a key concept in investment decisions, which is related to the financing. The subtopic is impact of financing on investment decisions. I started by saying that the financing choices, these are sources of finances, what the company decides in terms of the sources of financial finances projects. So the financing choices play a key role in shaping investment decisions. And we are studying the adjusted present value because the adjusted present value, which is a valuation method, helps us to understand the relationship between financing and investment. So the APV, just from that point, the first component of APV is one, the unlevered value. The unlevered value is the value of the project, assuming that it is financed entirely by equity. There is no debt. Unlevered means no debt. And this value is calculated by discounting. It is calculated by discounting the cash flows. By discounting the cash flows, the project's expected future cash flows, using the unlevered cost of equity. Then number two, we have the financing side effects. financing side effects. Financing side effects. And the financing side effects includes the value of impacts of various financing decisions. Impacts of various financing decisions, like the tax shield. Tax shields from debt. Like A, the tax shields from debt. Debt tax shield. The debt tax shield. Now, this refers to the tax deductible of interest payments on debt, which reduces the company's tax liability, which then increases cash flows. So it is the present value of these tax savings that is added to the unlevered value. We may have other costs like distress, financial distress, cost of financial distress. And that is just a possibility of bankruptcy or financial difficulties that are associated with the debt, which can then create costs. And is calculated by getting the present value of the potential costs that then is then subtracted from the unlevered value. Distress costs. Distress, cost of financial distress. Cost of financial distress. We are studying candidates. First of all, the components. We've defined what APV is. We are now moving to components of APV. The first major component here is the unlevered value. We've seen how it is calculated. We discount all the cash flows that are associated with the project using the required rate of return. Then there is a financing side effects. One such financing side effect is a tax shields from debt. Then you have financial distress costs. There are other costs on benefits, which include issuance costs. Issuance costs. Issuance. Other costs include issuance costs, subsidies, and so on. So those are two major categories of the components of the APV. So candidates, the adjusted present value, we've said is a valuation method that is used to assess the financial worth of a project or an investment, particularly when it involves complex financing structures with debt and equity. So it is, as we've seen, a variation of the traditional NPV that explicitly accounts for the impact of financing decisions. So we have, first of all, if you are to calculate the APV, you have to first of all determine the unlevered value, the all equity value. Then we add the present values of financing side effects, like the tax shields from debt. Then we also deduct the cost of financial distress and other costs like the issuance costs and so on. Now, we'll take an illustration to reinforce what we just learned. Illustration on Treetop Limited. So that's the question. Treetop Limited is considering an investment project in the tourism industry worth 48 million, which will be a diversification from the mainstream activities. The 48 million shillings project cost will be financed as follows: 10 million using internal funds, 20 million using rights issue, and 18 million with long-term loans. The investment is expected to generate pre-tax net cash flows of approximately 14 million shillings per year for a period of 10 years. So currently those are net cash flows. Net cash flows. So underline pre-tax net cash flows. Pre-tax net cash flows. Underline it. Pre-tax net cash flows. Approximately 14 million shillings per year for a period of 10 years. That is our period. The residual value at the end of the 10-year period will be 15 million shillings after taxes. You see that again? After taxes. As the investment is in an area where the government wishes to develop, in that area in which this treetop is trying to invest, and therefore there is a subsidized loan of 8 million out of the total of the 18 million that is available, and the cost will be this will cost 2% below the company's normal cost of long-term debt, which is 8%. Look at that. This will cost 2% below the company's normal cost of long-term debt finance, which is 8%. Below. So that 2% is a saving. It is a saving. The company will save 2% for the 10 years. Additional information: the company's equity beta is 0.85 and its financial gearing is 60% equity and 40% debt by value. Number 2, the average equity beta in the tourism industry, that is now the market. It is the tourism industry is the market beta. There is 1.2. And average gearing is 50% equity, 50% debt by market value. Number 3, the risk-free rate is 5.5% per annum. The market return is 12% per annum. Number 5, issuance costs are estimated to be 1% of debt financing, excluding the subsidized loan, and 4% for equity financing. These costs are not tax allowable. Underline that. Not tax allowable. Number 6, the corporation tax rate is 30% required. The adjusted present value of the proposed investment project. Roman 2, propose 3 circumstances under which the APV may be preferred to the net present value approach as a method of evaluating capital investment project. So then let's first calculate adjusted NPV. Adjusted NPV ratio. adjusted present value. Adjusted present value. What is the formula? Base cost NPV. Cost NPV. That is the unlevered value. Then we add what is termed as the financing effects. The financing effects. The financing effects. From this question, we have the savings. You recall savings in not the last sentence there. The last sentence there, it reads that what does it say? This will cost 2% below the company's normal cost of long-term debt finance, which is 8%. So we have the interest savings. So we are going to add present value of interest savings. That is an inflow. Okay, we add it to the NPV. So we have the base cost NPV, which is an unlevered value. We add the present value of savings. Then if there is any tax shield, we add it. Add present value of tax shield, which we have. Present value of the tax shield. Present value of the tax shield. Do you see that in the question? Then did we say we deduct the issuance costs? Do we have issuance costs in the illustration? Yes. Look at note number 5. Issue costs are estimated to be 1% of debt financing, excluding the subsidized loan, and 4% of the equity financing. These costs are not tax allowable. All right. So we are going to deduct the present value of issue costs. So from the information provided candidates, the adjusted PV is equal to the base cost NPV plus the present value of interest savings, which is an income, plus the present value of tax shield, which is an income. Then we deduct this issue cost, present value of issue. That will give us the adjusted PV. So then let's begin with the base cost NPV. The base cost NPV. So then, candidates, you recall we say that the first thing to do is to calculate the unlevered value. This is the NPV of the project, assuming that the company is all unlevered. Base cost NPV. So let's have some working here. We need a workings. We all know that NPV, candidates, NPV is equal to present value cash inflows minus present value cash outflows. NPV. That's the formula for NPV. NPV is equal to present value cash inflows, present value of cash inflows minus present value of cash outflows. So what are the inflows? In sentence number, the third sentence, third paragraph reads, the investment is expected to generate pre-tax net cash flows of approximately 14 million shillings per year for a period of 10 years. That is the first inflow. Do you see that? Then we also have the next sentence which reads, the residual value at the end of the 10-year period will be 15 million shillings after taxes. That is terminal cash flow, which is an inflow. After 10 years, the company will have this inflow, 15 million. So those are two inflows. And we have the outflow. In the second sentence, is it the second or the first? The first sentence reads that Treetop Limited is considering an investment project in the tourism industry worth 48 million. So that is the outflow. So we have two inflows and one outflow. Two inflows, one outflow. So candidates, you can see that inflow, the first inflow of, how much was it? 14 million. The investment is expected to generate pre-tax net cash flows of approximately 14 million shillings per year for a period of 10 years. Pre-tax net cash flow. I told you to underline pre-tax. That means that tax has not been deducted. So we have, first of all, two inflows. We have the annuity, which you have to, this is a cash flow which you have to discount. We get the present value. So the present value of an annuity we know is PVI, present value interest factor, present value interest factor of an annuity, R percent, which we do not have. Then we have N, which we have. So this is the first inflow. We add the, what do you call it? The residual value. The residual value is how much? The residual value is how much? We have the residual value. The residual value at the end of 10 years, 15 million. That is a lump sum. So we're going to discount that residual value using the present value interest factor Rn minus the PVCOF, the present value of cash outflow, which is the initial investment. The initial investment here is 48 million. So candidates, that's the formula for calculating the NPV, the best cost NPV. So we do not have the annuity we have to calculate. So we have a working within a working. In discounting this annuity, we need to have a discounting rate, which we again do not have. Do you understand? Pre-tax net cash inflows, but we need the after-tax net cash flows. So the after-tax cash inflow will be equal to the pre-tax be equal to the pre-tax net cash flows of 14 million. Then we deduct the tax 1.03. This will be the after-tax cash inflow, which is our annuity here. How much is it? So this is 9.8 times the present value annuity factor. We have the period, but we do not have the rate. How do we determine the rate? Do we have the rate from this question? I didn't see any rate. I saw the market return. This will cost 2%. So candidates, we do not have the discounting rate. We do not have the discounting rate. So we have to determine the discounting rate. The discounting rate. And you recall we said that when discounting the base cost, we use the required rate of return. All right. So we do not have the discounting rate. So the discounting rate should be the weighted average cost of capital of the unlevered farm. The unlevered farm. We need to calculate the discounting rate. We do not have the discounting. This is 9.8 million. So for us to discount this cash flow, we need to have the discounting rate. So the discounting rate here is the weighted average cost of equity, the weighted average cost of capital, the weighted average cost of capital. And we are here to assume, candidates, that the farm is wholly unlevered. So we'll use CAPM to calculate this discounting rate, which is equal to the risk-free rate plus the, what do you call it, the beta of the unlevered farm, beta of the unlevered farm times the premium, that is RM minus RF. Do we have the risk-free rate? Yes, the risk-free rate is 5.5. The beta of the unlevered farm, beta of the unlevered farm. We do not have the beta for unlevered farm. Do we have the market return? Do we have the market return? Yes, the market return, you remember we circled it. The market return, look at the last, note number 4. The market return is 12%. The market return is 12%. The risk-free rate is 5.5. So again, candidates, you can see we are doing this working so that we can determine the present value of cost of equity. In calculating the present value, we need to have this discounting rate, which we do not have. So this is the formula that helps us get that discounting rate. But again, in calculating the discounting rate, we do not have the beta of the unlevered. This is unlevered. Beta of the unlevered farm. So we need to have another working candidates for beta of the unlevered farm. And we know this is equal to beta of the levered farm divide by 1 plus t, 1 minus t, this is 1 minus t, d over e. The ratio. This is the ratio of debt to equity. So do we have beta for the levered farm? Do we have it? Do we have it? Beta from the question? Do we have beta for the levered farm from the question? Beta for the levered farm? Yes, we have it. Look at one number 2. The average equity beta in the tourism industry is 1.2, and averaging gearing is 50% equity, 50% debt. So we have it there. The beta of the unlevered is 1.2. We divide by 1 plus, this is 0.7, 1 minus t. Then we have 50 over 50. 50-50. That is the ratio. Debt to equity ratio. How much is it? So this is 0.706. That is the beta of the unlevered farm. The unlevered farm is a farm that has no debt in its capital structure. So you come here and substitute plus 0.706. So what is the discount? What is the discounting rate? What is the discounting rate? 10% is the discounting rate. So this is what we need here. So the present value interest factor of annuity 10%, 10 years. From the tables, what do you get? Plus the residual value. What was the residual value? The residual value from the question, that is not number. The residual value at the end of the 10 years will be 15 million. So we have plus 15 million into present value interest factor 10%, 10 years minus 48 million. Can I have the NPV? So that is how to calculate the base cost. Then candidates, the next thing to do is to calculate the present value of interest savings. Now look here, candidates. Look at the board. The first step is to calculate the base cost NPV. The base cost NPV, that is step number 1. We determine the net present value of the investment project on assumption that the farm's capital structure is all equity. Then the next stage is to calculate the present value of interest savings. Present value of interest savings. Now, before calculating the present value of interest savings, first of all, we need to determine the interest savings. It's present value of interest savings. Present means we discount the interest savings. So first of all, we need to calculate the interest savings. And look at the information on interest. Look at the information on interest. In the last sentence there, we read that we read that this will cost 2%. Below that we read, before that we read, as the investment in this is in an area where the government wishes to develop, a subsidized loan of 8 million out of the total 18 million is available. Now you recall in the second sentence we read that the 48 million project cost will be financed as follows: 10 million using internal funds, 20 million using rights issue, 18 million with long-term loans. So underline 18 million, because in the second last sentence we now read that as the investment is an area where the government will develop, a subsidized loan of 8 million out of the total 18 million is available. This company has an advantage because the company is investing in an area where the government wishes to develop. So the government will give this company a subsidized loan of 8 million out of the total 18 million. And this will cost 2% below the company's normal cost of long-term debt finance, which is 8%. That is the information that is going to help us determine interest savings. Interest savings. So the saving there, we even have the percentage. The percentage is 2%. So we need to calculate, first of all, the saving. Interest saving. The interest rate is 2%. So the government, the government is offering us a subsidized loan. And what is the value of this loan? Look at the question. The value of this loan is 8 million. 8 million. So the government will advance 8 million. Okay? And therefore, the company is going to save 2% of the 8 million. How much is it? 160,000. So that is the saving, interest saving. Interest saving is 160,000 shillings. So having calculated the interest saving, we can now determine the present value of the interest saving. Present value of interest saving. So we get the present value of this saving. So it is going to be just the interest times the present value annuity factor. Okay? Which is equal to 160 million times present value interest factor of annuity. What is the discounting rate? So this is 5.5%, 10 years. How much is it? It is risk-free. What is the present value of 160,000? Present value interest factor of an annuity, 5.5%, 10 years. How much is it? Give me the present value of this interest contest. You know, the saving is 160,000. Present value interest factor of annuity, 5.5%, 10 years. Times 0.7. That is 1 minus t. How much is it? Let me write it down here. This is equal to this, which is equal to this. Give me the present value of interest savings. Present value of interest savings. So step number 2, calculate present value of interest savings. Step number 3, calculate the present value of interest tax shield. Present value of interest tax shield. Present value of interest tax shield. So look at the last 2 sentences. As the investment is in an area where the government wishes to develop, a subsidized loan of 8 million shillings out of the total 18 million shillings is available. This will cost 2% below the company's normal cost of long-term debt finance, which is 8%. Which is 8%. So we have to calculate the interest tax shield. The interest tax shield. So there are 2 loans here, candidates. There are 2 loans. There are 2 loans. The 8 million loan and the 10 million loan. So before calculating the interest tax shield, we first calculate the interest. Interest. So there are 2 loans with different interest rates. Can you see that from the question? We have the 6% interest rate, the 6% interest rate on the subsidized loan of 8 million. Then we have the 8% interest rate on the 10 million loan. So this is the interest. So to calculate the interest tax shield, first of all you calculate the interest, then you just apply the tax. Do you understand? What you get here, we're going to discount. So this is the interest tax shield. We then calculate the present value, we discount it with this factor, present value annuity factor 5.5, 10 years. So that will give us a present value of interest tax shield. So do you understand the procedure? Before you discount, first of all you calculate the interest, because it is interest of a present value of interest tax shield. So first calculate the interest, which is 30% of 6% of 8 million plus 8% of 10 million. So that gives us the interest. Then after calculating the interest, then you apply the tax, which is 30%. So this now, what I have in the larger bracket is the interest tax shield or interest tax benefit. Then to discount, you apply the present value annuity factor 5%, 10 years. So that will be the present value of the interest tax shield. How much is it? 2894. There are two people who've gotten that. 2894 592. So that is the present value of interest tax shield. Can someone confirm? Present value of issue cost. Present value of issue cost. Present value of issue cost is obtained. Information on issue cost is obtained. The second last additional information. Issue costs are estimated to be 1% of debt financing, excluding the subsidized loan, and 4% for equity financing. These costs are not tax allowable. These costs are not tax allowable. So there are two categories of issue costs. So it is 4% for equity financing and 1% for debt financing, excluding the subsidized loan. Because if the loan is subsidized, then you may not have to incur issue costs. So issue costs are two. We have the issue costs on equity. Issue cost. Is it equity or what language is used? Let's look at the question. The 48 million project cost will be financed as follows: 10% million using internal funds, 20 million using rights issue. So this is issue on rights issue. Rights issue. And we are told the rate is, what is the rate? The rate is 4%. It will be 4% of the rights issue. The rights issue 18 million. Then we add issue costs on the loan, which you have seen is 1%, excluding the subsidized loan. So it's 10 million. So these two will give us the present value. 4% of 18 million, 800,000. This will just be 100,000. And this, the total is 900. So, are we going to discount? No, we can't discount because these were issued at the beginning of the project. The rights issue were issued at the beginning. So they are in present terms. So that's the present value of issue costs. Can we have the NPV? Because we now have present value of interest savings. Present value of interest savings. Present value, do we have it? You didn't give me. Then there is a present value of tax shield. Present value of taxes, we have it here. 28,94592. Then we deduct the 900,000 issue costs. So give me the base cost NPV and the present value of interest savings. Oh, let me ask a question here, down here. I think you have a problem here. Is it here? Which factor are you using here? Give me the factor. I think I can use my phone to calculate this. This is 9.8. Give me the factor. 10%, read from your tables. Is it 6.11? 6.1446 plus 15 million present value interest factor. This one, what is the factor? What is the factor? So this is 17,999.58. 17,999.58. Again, Maggie, you omitted something or something, because if it is 17 million, when I put my 3 digits here, you must have omitted something. Is it 0? So the base cost 17,999,580 plus present value of interest savings. So this present value candidates, there are 2 ways. There are 2 ways to it. You can have the 160,000, you multiply by this factor, which I think you had done it somewhere. The factor 5.5, 5.5. Yeah, I think how much is it? 1 minus t. This is 0.7. That's the surest way, candidates. So how much is it? What is the present value of the interest saving? 838,000 to 30. If you have to round off to the nearest ceiling, 230. That is the adjusted present value. So candidates, there was another part. Propose 3 circumstances under which the APV may be preferred to the NPV as a method of evaluating capital investment projects. These are things we discussed when we began, candidates. Circumstances. Let me answer it. We may not have time to come back here. Circumstances under which APV is more preferred than NPV. Now, one circumstance is in relation to complexity. Complex and changing capital structures. Complex and changing capital structures. Complex and changing capital structures. Number 2, significant tax benefits. Significant tax benefits. And these are tax benefits from debt. When a project is expected to generate, say, substantial tax shields from debt, and that may be due to high interest payments and favorable tax environment, then that's a situation where APV will be more preferable. And why is it preferred? Is because APV directly incorporates the present value of the tax benefits into the valuation, which offers a more precise measure of the project's true value. So where the company is to enjoy significant tax benefits, then APV is more preferred than NPV. 3, projects with financial distress. Recall candidates, these are the things I discussed before we got into the calculations. So that's it for the lesson. Is there any question? Assignment. Blaze Limited is considering diversifying its operation away from its main areas of business into the plastic business. The company wishes to evaluate an investment project which involves acquisition of a molding machine that costs 450,000 million. The project is expected to produce net annual operating cash flows of 220 million for each of the 3 years of its useful life. Its salvage value is 0. The assets of the project will support debt finance of 40% of its initial costs, including issue costs. The loan is to be repaid in 3 equal annual installments. The balance of the finance will be provided by placing of new equity. Issue costs will be 5% for the equity and 2% of the loan. Debt issue costs are allowable for tax. The plastic industry has an average equity beta of 1.368 and an average of debt to equity ratio of 1.5 at market values. Blaze Limited's current equity beta is 1.8 and 20% of its long-term capital is represented by debt, which is generally regarded to be risk-free. The risk-free rate is 10% per annum, and the expected return on an average market portfolio is 15%. Corporation tax is 30%. The machine will attract 70% initial cost allowable, and the balance will be written off evenly over the remainder of the assets life and will be allowable against tax. The firm is certain that it will earn sufficient profits against which to offset these allowances required using adjusted net present value advice whether or not the project is worthwhile. Thank you for your time. Bye-bye. Capital rationing refers to a situation where a firm has limited access to capital and therefore cannot pursue all investment projects that may appear financially viable.
Welcome to Manifested Publishers. My name is Mr. Dongo, an economics lecturer. We proceed from the previous session, that is economics, August 2024 paper. We'll pick from question 7 and we'll read it. Using a well-labeled diagram, distinguish between inflationary gap and deflationary gap as used in national statistics, national income statistics. So we put it down. We say that one is using a well-labeled diagram. Distinguish between inflationary, distinguish between inflationary gap and deflationary, what you call the deflationary gap as used in national income statistics, as used in national income statistics, as used in the national income statistics. So the first thing we can pick from the first one, that is inflationary gap, and we understand what inflationary gap before we put it down. We need to understand that whenever we talk about inflationary gap is basically the amount in which aggregate demand must be decreased in order to reduce the national income. The amount at which the aggregate demand must be reduced to in order to reduce the national income, what you call equilibrium national income to the full employment of national income. So we can put it down. Amount at which we start with the inflationary gap. Inflationary gap. We say amount by which the aggregate demand must be reduced stroke decreased in order to reduce the equilibrium, what you call equilibrium, in order to reduce the equilibrium level of national income, in order to reduce the equilibrium level of national income to the full national income, to the full what you call full employment, to the full employment level of the national to the full employment of national income. Just to emphasize on what I have said, when you talk about inflationary gap, you're basically saying the amount by which aggregate demand must be reduced or increased in order to reduce what you call equilibrium national level of income to the full employment level of national income. So we go straight forward to the diagram. So we have the diagram. We have the diagram. We have the diagram. We have the diagram. So then we have 45 degree. This should be 45 degree. That is for the aggregate demand. This is 45 degrees. So this we call it D. That is what we call AD, we call aggregate demand. And this aggregate demand is basically equals to national income stroke the G, stroke the GNP, stroke the GNP. Then we have that. We join this. That is YE, YF. That should be YF. Then we have YF at that point. That is equilibrium national income. YF should be here at this point. This is what you have as YF. And we have down here, this is what we call inflationary. We call it the inflationary gap. The amount at which the aggregate demand must be reduced, that must be decreased or reduced in order to reduce the equilibrium level to a full employment of the national income, This we have as aggregate. We have this as aggregate. We call it the aggregate demand. So This is what we call the inflationary gap. We need to know what YF and YE means. YE is what you call, YE is basically, YF is represents, we call it represents full, what you call full employment. Full employment represents full employment of national income. Then YE, Y basically in economics will represent national income. YE is what you call equilibrium national income. We call it equilibrium national, what you call the equilibrium national income. We call it the equilibrium national income. What is the purpose of the inflationary gap? Very important. So we need to understand that inflationary gap, what you call the inflationary gap, causes inflation. This will causes inflation in the economy. Causes inflation in the economy. What you call inflationary gap basically will cause inflation in the economy. This will basically cause inflation. So the inflationary gap is this: how much the aggregate demand should be reduced in order to reduce the equilibrium level of national income to full employment of national income. The second is what we call deflationary gap. The second diagram is on the deflationary gap. We will illustrate on how we distribute those particular amounts. So when you talk about deflationary gap, is now the opposite. How much amount by which aggregate demand should be increased in order to raise the national income to full employment of national income. So how much? We say amount by which aggregate demand, that is AD, aggregate demand should be increased in order to raise what we call equilibrium, in order to raise the equilibrium national income to full employment of the national income, to full employment of the national income. That is what we basically mean by the deflationary gap. How do we depict that diagram? So in that diagram we have, this is on we call aggregate demand, and that is AD, aggregate demand, 45 degree. This should be 45 degree. So this is the AD, where we say that AD is equals to GNP. AD is equals to GNP. And then we have that AD is equals to GNP. So we have that point. That should be YE. That should be YF. That should be YF. Then we have this. We have that. That should be YE. Where do we have the deflationary gap? It is this point that we call the deflationary. We call it the deflationary gap. We basically call it the deflationary gap at that point. So deflationary gap, we need to understand that YF We basically say Y represents full employment, what you call the full employment of national income, full employment of national income. And then we know that YE equilibrium, what you call equilibrium national income. That is basically equilibrium national income. What does deflationary? A very good point on an explanation. What does the deflationary gap cause? It causes deflation. We say causes deflation, which is the opposite of inflation in an economy. Causes deflation in an economy. We know that inflation is the persistent rise in the prices of commodity in an economy. When you talk about deflation, the prices are not rising. So deflationary gap causes deflation in an economy. But it's basically how much the aggregate demand should be reduced in order to raise what we call the equilibrium national income to full employment of the national income. So on the distribution, if you look at that question keenly, that question particularly has constituted about 10 marks, to imply that when we're explaining on the diagram, on the deflationary gap, you can have 4 and maybe the explanation of what inflationary gap means. The diagram to take 4, then the explanation to take the diagram, explanation 1 and the diagram 4. Or you can have the diagram 4 and the explanation what we mean by deflationary 1 mark, and therefore you have your 10 mark. Still on that area, there are a number of things, how do we control those such deflationary and inflationary gap measures that are taken is a particular area that learners can actually look at, and that is how we approach the very question that is 7A. We pick from the next question, that is 7B. We read the question, then we put it down. Highlight 4 principles of a good tax system. 7B. 7B. Highlight 4 principles of a good tax system. Highlight 4 principles of a good tax system. When you talk about principles of good tax system, these are basically factors that are basically being used to describe a good taxation system. We know that the very first principles were developed by a scholar who was an economist called Adam Smith. And he said that a good tax system, one of the principles, we have number one principle, we call it the principle of equity. Equity, that is fairness. Fairness, that is to say, a good tax system. People should pay, people should pay based on their ability, based on their ability to pay. That is to imply the more income, the more tax you pay. The more income, the more the income, the more the taxes to be paid. The more the income, we say the more the taxes basically to be paid. The more the income, basically the more the taxes to be paid. We can talk about the second principle, which is economy. Economy simply say that a good tax system should be cost effective. A good tax system should be cost effective. Cost effective. What do we mean by cost effective? The cost of tax should not be more. It should not burden. The cost of tax should not be more than the tax collected. The cost of tax should not be more than, we say should not be more than the taxes collected. The taxes collected. The cost of collecting taxes should not be more than the tax collected. We can have the next, we call it the principle of convenience. We call it convenience. Convenience. The principles of convenience. We are basically saying that a good tax system should not, the taxpayer, a good tax system should not, a good tax system should not inconvenience the taxpayer and the tax collector in terms of the mode of payment, in terms of the mode of payment, time, etc. It should be clear in terms of how should those taxes be paid and at what time should it be paid, and many other aspects of the tax. Then we can have the last one. Simplicity. When you talk about simplicity, it basically says that a good tax system should be understood by a common person. A good tax system should be understood by a common person. That a good tax system should be basically understood by a common person. But you can illustrate, just put them down, some of the principles of a good tax system. We can have certainty, that is basically surety. Certainty as also a factor, where you're sure as a taxpayer, you're sure of the amount that you need to remit in terms of taxes, and the tax collectors are also sure of what they expect in form of tax. We can also have the last, we call it diversity. That a good tax system should have variety, so that all the population in the economy should be paying taxes when you have a variety of the taxes, And that is how we approach that very question on the principles of a good tax system. We pick it on our next question. That is question 7C. We read the question. A firm operating under a perfectly competitive market has the demand and total cost function represented as follows. So we have P being equals to 40 minus 60Q. We have TC, which is the total cost, being equals to 100 plus 50Q minus 80Q squared. And you're being told that where P is price, Q is quantity, C is total cost. And then we are told to determine the average fixed cost function, and we are told to find the average variable cost function. And lastly, 3, we are told to determine marginal cost function. We put it down on the board. That is 7C. Determine a firm operating under a perfectly competitive market, has the demand and total, what we call the total cost function represented by the following. Represented by the following. Has the total cost function, the demand and the total cost function represented by the following. So the demand function, we say P is equals to 40. P is equals to 40 minus 60Q. And then we have total cost, which is the TC, equals to 100 plus 50Q minus what we call 80Q squared. That is the total cost function. Then we're told where P is equals to price. So we have P is equals to price. We have Q is equals to quantity. And then TC is what we call total cost. Then say required or determine. Determine. The first one is what we call average fixed cost function. Average fixed cost function. Then we have B. We have what we call average variable cost function. Average variable cost. Average variable cost function. Average variable cost function. And lastly, that is C. C, we can talk about marginal, what we call the marginal cost function. Marginal cost function. So we proceed. We start with the first one. Average fixed cost. Average fixed cost function. How do you determine average fixed cost function? We say fixed cost over Q. That is fixed cost over Q. Fixed cost. That is say fixed cost over quantity. The first thing is to determine what we call the fixed cost. Is to determine the fixed cost. The first thing is to determine the fixed cost. Where do we get the fixed cost? We get the fixed cost from the total cost function. So we write down the total cost function. We have it there. So TC, which is the total cost, is 100 plus 50Q minus 80Q squared. So what is a fixed cost? We say that fixed cost is independent, is not affected by quantity. So from the total cost function, we know that the fixed cost, we look for a factor that is independent, not affected by quantity. So the fixed cost in that question should be 100. Is not dependent on the quantity. Whenever we talk about fixed costs, like when you talk about the rents are not, whether you've done business and made money, it is independent. So if you're looking for the total cost function, we pick the cost, the part of the cost that is independent of Q. So total fixed cost is 100. So how do I get average fixed cost? That should be, as I said, fixed cost over Q. So that would be 100 over Q. So average fixed cost should be 100 over Q. That is what you call average fixed cost. We move to the second one, which is Roman 2, not B. This is Roman 1. This is Roman 2. This is Roman 3. So this is Roman 1. So then Roman 2 is the average variable cost. So variable cost in this particular question we know is dependent on the quantity. Average variable cost is dependent on the quantity. So on that we have this part. So average variable cost, we get the variable cost first of all. So variable cost we know is dependent. So that should be 50Q. That should be 50Q minus 80Q squared. That is the variable cost. How do I get now average variable cost? That should be the variable cost over Q. That should be the variable cost over Q. That should be the variable cost over Q. So the part of the variable cost, that should be 50Q minus 80Q squared. You divide by Q. You divide by Q. What do? I'll come and have 50Q over Q, then minus that should be 80Q. We have noted it here. 80Q squared minus 80Q squared over Q. So this Q goes with this. So we have 50. We have 50. Q squared, that would mean 80 times Q times Q. So this will go with this. So we have minus 80Q. So average variable cost should be 50 minus 80 Q. That is the average variable cost function. That is the average variable cost function. Then we have the next, that is a marginal cost. We have what we call marginal cost function. Marginal, that is Roman 3. Marginal, what we call the marginal cost, marginal cost function. Marginal cost function. What we call the marginal cost function. If I have total cost, total cost, and I want marginal cost, what do? We say we differentiate. If I have total cost and I want marginal cost function, I differentiate the total. We differentiate the total cost function. You differentiate the total cost function. We come and give the total cost function. Total cost function is basically 100. We say 100 plus 50 Q minus 80 Q squared. 80 Q squared. That is the total. We differentiate in relation to Q. 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 We differentiate in relation to Q. The first part, which is a fixed bar, we can't differentiate because in relation to Q, there's no coefficient of Q. But the first one is 50. We have the 50 Q. How do I differentiate? This is raised to 1. So we say 1 times 50, then Q was 1 minus 1. So we're going to have 50 raised Q raised to 0. Any number raised to 0 is 1. Any number, law of indices, any number raised to 0 equals to 1. So when you have 50Q raised to 0, so Q raised to 0 is 1. So once we differentiate, we have 50. Then we differentiate the second coefficient, that is negative 80 Q squared. So what are we going to do? We're going to say 2 times negative 80, 2 times negative 80 raised to Q, that was 2, you minus 1. So this will be negative 160, 2 times 80, negative 160, over Q raised to 1. So the marginal cost function in this case is going to be 50 minus 160Q. 50 minus 160Q minus 160Q. And that is the marginal cost. On this particular question, there's still a number of things that can be exhausted as a learner. The examiner can, maybe on the next sitting or in the sittings to come, the examiner can also exhaust on the part of marginal revenue. And how do we get total revenue? How do we get total revenue? Just as an additional, we need to understand that the total revenue, if we have a demand function which is P, it should be P times Q to get the total revenue. And once you have the total revenue, what is the approach? How can I get the marginal revenue? I differentiate the total revenue. Again, when you have these marginal revenues and you want total revenue, now you need to go backward, and that will mean that we integrate instead of differentiation. And I just want to say this on this particular question that involves calculation. If the student is very keen this particular question should be perfectly done. This particular question should be perfectly done. And that marks the end of the paper and marks the end of that question 7. We wish you well and God bless you. Unemployment income. So we read the question. Talisa Barra is a citizen of South Africa, into bracket SA, and was employed by Bright Insurance Limited as a senior financial advisor in the year 2020. Then we proceed to say in January 2023 was posted to work and to be paid by a company branch in Kenya on a 5-year contract. She had the following income from her employment income for the year of income 2023, for the year of income 2023. So then we're being told that the first information, we are being told that the basic salary of 300,000 per month, net of pay, into bracket PAY, of shillings 50,000. So number one, you need to understand that basic salary is a taxable income. Basic salary is a taxable income. And when the basic salary is net of pay, we need to add back the pay in order to get the gross employment income. Number two, we are being told that the employer paid for a passage of shillings 200,000 during the year. And when you talk about passage, the passage is basically the cost of moving from one point to another during employment. She used 30% of the amount to visit a tourist site. So basically very important for learners to understand whenever we are talking about the cost of passage, there are basically 3 instances where the cost of passage is not taxed. One is when the employee is a non-citizen. Number 2, we say that when the whole amount was basically spent on passage. And number 3, we say that if the employer is the employee's here in Kenya for the sole purpose of serving the employer. We're seeing about 30% was not basically spent on serving the employer. One, the 30% was a visit to a local tourist, implying that the whole 200,000 on the passage is basically being taxed. Number 3, we are being told that in March 2023, she bought 15,000 shares of 15,000 shares of the company at a price of 30 per share, although the market value was 35,000 per share. At the end of the year, she received dividends of 6,000. So when you look at that, there's a working, that is question 3B. Question 3B. There's working, we call it working 1. We call it share benefit. Share benefit. So share benefit is basically when employees are given shares at a value, at 0 value, maybe for free, or given shares at a value less than the market value. That gives us what we call the share benefit. How do you calculate? The amount of shares that are given times, you open the bracket, the market value minus the cost given by the employer. So in this case, the share benefit will be 15,000 times 5. So the share benefit is basically 75,000. That is for the additional information number 3. The share benefit is 15,000. The share benefit is basically 15,000. So then we're being told that at the end of the year, Talisa Barra was able to receive a dividends worth 6,000. Dividends received from shares that are held by individuals, we call them qualifying dividends. The 15% withholding tax, the 5% withholding tax is final. That is for the resident. The 5% withholding tax is final. We do not subject it to further taxation. The next, we're being told that she was provided with accommodation by the employer. The employer leased a house at a rental of 120,000. The house was fully furnished at a cost of 400,000, and she had a house servant whom the employer pays a salary of 20,000 per month. So two things or three things particularly in this. So on that, we can just call it working two. And working two, we have three things. So we have housing benefit, we have furniture benefit, and finally we have what you call the servant benefit. And the servant benefit. Housing benefit should be the last item because we get the housing benefit after getting the total employment benefit. So then we say, how do we get? We can just put the formula. If you're to look for housing benefit, we're going to say 15% of the employment income. Then rent paid, you compared with the rent paid or the market value. You pick the high of the two on this benefit. Then you can less own contribution, what you call own contribution towards rent. If it's there, if there's a portion of the income that was basically being deducted towards the rent, you deduct it after comparing the I of the two. The second one which can work is the furniture benefit. Furniture benefit should be 1% times the number of months, which is 12, and the cost of furniture. The house was furnished at a figure of 400,000. The house was basically furnished at a figure of 400,000. So the housing benefit will be 0.01 times 12 times 400,000. So the housing benefit in this particular question is 48,000. That is the housing benefit. And the last one is what you call a servant benefit. This is where employer provides employee, for example, with a chef, with a gardener, with a watchman or a driver. And this basically is paid by the employer. How do we calculate? We say cost to the employer, and you basically compare with the market rate. If it's provided, then you pick the higher. In this case, the cost to the employer is basically the employer pays 20,000 per month. So that should be 20,000 times 12, that is 240. If you look at that particular question, we've not been given the market rate. So we know that the market rate is 0. So the servant benefit in this particular question, servant benefit is equals to 240. That is what we have as the servant benefit. So this is taxable. We know that this is taxable. It's a taxable benefit. This is taxable. This one is also taxable, although we will get it after getting total employment income. This is taxable. This is also taxable. It's a taxable benefit. Together on that. We proceed to the next, that is additional information number 5. So we're saying that additional information number 5, in the month of October, she worked in a company headquarters in South Africa. In the month of October, she worked in a company headquarters in South Africa, where she was tasked with the responsibility of training employees in a newly installed finance software. She received a salary for the month from the branch in Kenya. That is basically on the basic salary. That will be tied to the basic salary. So the same for that year. And we know that for one to qualify to be a resident, we know that if one... So in the month of October again, she worked in a company headquarters in South Africa, where she was tasked with the responsibility of training employees in a newly installed finance software. She received a salary for the month from Kenya at the branch. At the branch, to receive the salary for the month from Kenyan branch, which is part of the basic salary. So that is not affected whether he was working in South Africa, is still entitled to the salary in Kenya. So then number 6, additional information. We are being told that she was provided with the leased motor vehicle, 2000 cc, by the employer. The vehicle was leased from Better Light Motors at a monthly charge of 60,000. Better Light Motors bought the vehicle in 1st January 2022 for 3.2, but the value of the vehicle in January 2023 is 2.4. So we can have that as a working 3. We can have that as a working 3. And we call that motor vehicle. We call it motor vehicle. We call it motor vehicle benefit. We call it the motor vehicle benefit. So for the motor vehicle benefit, we basically say that if the motor vehicle is owned by the company, it is basically 2% times the number of months times the initial, the word is initial, cost of MV. Initial cost of MV, you compare with the motor vehicle CC. So when you compare those two, you get the higher. You compare those two and you get the higher of those two. You compare those two and get those I of 2. That's the first scenario. And motor vehicle CC, that is cubic capacity. However, if the motor vehicle is leased, we say leased, stock hired from third party, we say the lease stock hiring value. We pick the lease stock hiring value. So in this particular question, the motor vehicle is basically leased, and the motor vehicle is leased at a figure of 60,000 per month. So we ignore the formula. We ignore formula, and we use the lease value. So that should be 60. Motor vehicle benefit in this particular question should be 60,000 times 12. So motor vehicle benefit is 720. And we know that this is a taxable. We call it taxable benefit. That should be a taxable benefit. That should basically be a taxable benefit. Then the next, we're being told that the employer paid for a life insurance amounting to 240 per year. So that is working form. We have what we call insurance benefit. So if the employer basically pays for eye insurance, that becomes a benefit, but at the same time, it is going to attract what we call insurance relief. So the 240, which is insurance, that is taxable, i.e. paid by employer, which is paid by the employer, We say taxable. In that case, that is basically paid by the employer. So we proceed to the next one, that is additional information number 8. During the year, she fell sick and was admitted at a local hospital. She paid for a bill of 180,000, which she was reimbursed by the employer. The company has a policy that covers all senior managers, and it provides up to a maximum of 1 million per year. So that is what we call, again, that we call it a working 5 medical benefit. And the explanation behind medical benefit is that medical benefit, we say that is taxable if the scheme, it is basically taxable if the scheme is discriminative, and if the scheme is non-discriminative, implying that it's given to all employees, we don't tax. So in this scenario, we're being told that this medical benefit was basically given to senior employees, implying that this is taxable. But there are two components. There's a maximum value that can be given, and there's what was utilized. So what is used as a medical benefit is utilized. Whatever was utilized that was reimbursed, that is 1A, 180. Then we have a taxable benefit since the medical scheme is discriminative. Since the medical scheme is basically discriminative. So then we have the next where we say that due to the nature of our work, the employer entered into agreement with Lesser Bite Hotel to be delivering meals to the office from 1st April at a cost of 15,000. From 1st April at a cost of 15,000. We say that for the meals, for them to be taxable, they have to be, if they're more than 4,000, then they should be taxable. If they're more than 4,000, they should be subjected to taxation. So those meal benefit. Look at the month. Meal benefit. We say that if it's above 4,000, then it's subjected to taxation. From April to December, 1st April, how many months are those? So April, we have April, May, June, July, August, September, October, November, and December, implying that for that meal we have 9 months. So the meal benefit is taxable, is above 4,000, that is 15 times 9. 15 times 9. And as we hold our calculator to get the figure, the meal benefit, that should be 15,000 times 9. So the benefit is 135. The benefit is basically, so this is taxable. That is basically taxable. That is basically taxable. That is basically taxable. Then you proceed to the next additional information. So the next additional information, we are being told that this we can call it working 6. We can call it additional information number 10. Our salary was adjusted upward by 30%, by 30,000 per month from 1st November and backdated to September. So we call it working 7 salary increment. We call it salary increment. So salary increment, that is working 7. So salary was increased by 30,000 and backdated. We say backdated to September. So when you have September to December, that should be basically 4 months. So salary increment, that should be 30,000 times 4. So 30,000 times 4, that should be basically be 120. And this 120 will add it to the basic salary. And this is taxable. That is basically taxable. That salary increment is basically taxable. So the next additional information, we're being told that the additional information number 11, we're being told that the employer contributed 15% of our basic salary to a registered pension scheme, and also she contributed 7.5 to the same scheme. Employer contribution to a registered pension scheme on behalf of employee is a tax-free benefit. However, if employee contributes to a registered pension scheme, that should be what we call allowable deduction. And allowable deduction, we basically use them to reduce the taxable income, Then lastly, the last additional information, she invested in real estate and financial sector during the year where she earned the following income. And the fact that this person was not only engaged, was there in Kenya for the sole purpose, this person also had investment. That explains why that whole passage of 200,000 should be basically taxed. So this other income we said that were earned, one is what we call the gross rental income. That's an investment income that is subjected to further taxation. Then you have dividends from Samco Society. So dividends from Samco Cooperative Society, we have, that's also taxable. Dividends from Samco Cooperative Society. We say Cooperative Society. We add at gross. We add it at gross. So the gross, the net, the figure that we're given as net, net is a figure of 85. So when you say net, a figure of 85, this is a less, we say less withholding tax of 15%. This basically implies that 85% is equals to 85,000. What is the gross, which is 100%? The gross, which is 100%, should be how much? So that should be 100 over 85 times 85,000 times 85,000. In this particular question, we know that gross div, that should be 100,000. So when you're adding back dividend from some cooperative, we call it a non-qualifying. The 15% withholding tax is not final. We're still subjected to further tax. We're still subjected to the further taxation. And then the next one that we have, we are told interest from Union Bank Limited. When you talk about interest from Union Bank, when individuals receive interest that is from the bank and insurance company, we call them qualifying interest. So the qualifying interest will basically imply that the 15% withholding tax is final and we do not subject them to further taxation. The 15% withholding tax is final and we do not subject them to further taxation. We do not subject them to further taxation. And lastly, we have consultancy fee for training, 114. So we have the next that we call consultancy fee, the other source, which is 114. And 114, we are told that this figure is net. 114, the figure is net. When you talk about 114, that figure is basically net. So 114, because this person, when you stay in a country, you may not have a permanent home, but automatically once you stay in a country for 183 days or more, you qualify to be a resident. So the 15% for the consultancy. For the consultancy, when you're told net, there was a 5% withholding on it. So 5% withholding. So that implies that 114,000 is basically equals to 95%. Remember, when we are doing our India taxes and we earn the consultant income, we get the value at gross, then we less allowable expenses. So the gross figure for the consultancy should be 100. 100 is a gross. What is 100, which is gross? So that should be 100 over 95 times 114. 100 over 95 times 114. So that's 100 over 95 times 114,000. So that should be, consultancy should be a figure of 120. So perfect on that. I want us to wrap the first part. I want us to wrap the first part. Then we begin the question. That was very important because that analysis is really key towards, we know is really key towards solving whatever we have. So the first question, compute taxable income for Talisa Bara for the year ended 31st December. So that is 3A Roman 1, 3B Roman 1, that is 3B Roman 1, 3B Roman 1, what we call compute taxable income. We say that the taxable income for Talisa Bara, for Talisa Bara, for the year, we say for the year ended, we say 31st of 12, 2023. So we'll say Talisa Bara, we'll say Talisa, what do you call Talisa Bara, taxable income, we call it taxable income, we say for 2023. Taxable income for 2023. And as usual, we run the question from the top. We had done most of the working. So we're saying that the first one was basic salary. So basic salary, we have the basic salary, which is gross should be, that was 300 net. So we have 350 times 12 350 times 12. Then you add plus salary increment, the plus salary increment, that was 30,000 times 4. So when you get 320, basic salary, we know that that is taxable. So basic salary, we know that 350 times 12, then you had plus 120. So the figure for the basic salary, that should be 4,320,000. And basic salary, we said, is taxable. The next taxable income is the passage. The next taxable, we call it the passage. And passage is taxable. Why? Because part of the amount was not involved in passage. The other one, they say there was tourism. So the whole of 200 is taxable. The whole of 200 is basically taxable. Then we also have number 3. In March, he bought 15,000 shares at a price of 30. So we say that share benefit, what you call share benefit. And the share benefit we were able to calculate, but still we can show 15,000. That is the number of shares given. Market value is 35 minus the price to which it was given. That will give us 75. That will basically be 75. Then the next, he was provided with accommodation by the employer. The employer leased the house at the monthly rental of 120. It was provided with the house by the employer. And the employer basically leased the house at a monthly rental charge of 120. The house was fully furnished at a cost of 400. And she had a house servant with whom the employer paid 20,000. So housing benefit, we cannot calculate it. We calculate it as the end. However, for the housing benefit, just as we've shown, housing, furniture benefit, the next furniture benefit. Housing benefit is the last. We have to get total employment. So furniture benefit should be 1% times 12, then times the figure is 400,000. So the furniture benefit in this particular question is 48. And also to remember something that I had explained when I was talking about the dividend, the share benefit. Dividends received by an individual, we call them qualifying dividends. For example, when you receive dividends from a company that you hold shares, the 5% withholding tax, that is for resident, is final. We do not subject it to further taxation. Then we have what you call, she had a house servant, so that is servant benefit. What you call a servant benefit, which is also taxable. Servant benefit, which is 20,000 times 12. And the market value is not there. So the higher is just the cost to the employer, which is 240. The next we are provided with, we are being told that she, in the month of October 2023, she worked in a company headquartered in South Africa, where she was tasked with the responsibility of training employees in a newly installed finance software. She received a salary for the month from the Kenyan branch, factored in the basic salary, which is taxable. And the next we have what called, she was additional information 6. She was provided with a leased vehicle of 2,000 cc. The vehicle was leased from Better Light Motors at a monthly charge of 60,000. Better Light Motors had bought the vehicle in January 2022 for 3.2, but the value of the vehicle in January 2023 was 2.4. We're saying that if you want getting motor vehicle benefit, 2% times month times the initial cost, you compare with motor vehicle CC. However, if the motor vehicle is leased or hired from third party, we ignore the formula and use the lease value. So that motor vehicle benefit, we use the lease value. Motor vehicle benefit, which is taxable, we use the lease value. Lease value. So the lease value should be 60,000 times 12. That should basically be 720. That should basically be 720. Then we proceed to the next, where we are told the employer paid for a life insurance cover. So we have insurance. If employer is paying for you That's the benefit. Insurance benefit, a figure of 240. Insurance benefit, a figure of 240. Insurance benefit, a figure of 240. Again, insurance, when we pay for insurance, education or a life insurance cover, it also attracts what we call insurance relief. When you're getting the tax payable, we are going to less what we call insurance relief. So the next we have what we call, during the year, she fell sick and was admitted at a local private hospital. She paid a bill of 180. She paid a bill of 180,000, which was reimbursed. The company has a policy to cover all senior. So we say that this is discriminative because it's basically covering, say, senior. But we don't use the maximum amount that is being provided, but we use the utilize. So we have medical benefit. Why do we use it? Because it's discriminative. It was given only to specific employees. That should be 180,000. That is for the medical benefit. That should be 180,000. Then due to the nature of work, she entered into agreement with Lesser Bite Hotel to deliver his meals to the office from 1st April 2023. The cost of meal was 15,000 per month. So the cost of meal for meals to be taxable, they have to be above 4,000. So we have meal benefits. That should be 15,000. But remember, from 1st April. So from 1st April to December, that should be 9 months. When we multiply that, we should be having a figure of 135. We should be having a figure of 135. Then our salary was adjusted. Our salary was adjusted upward by 30 from 1st November and backdated to September. That is factored. So September to December, that is 4 months. So that should be 30 times 4. That is already factored on the basic salary, which is taxable. Then employer contributes 15% of our basic salary towards a registered pension, and she also contributes 7.5% of the same to the same scheme. So employer's contribution towards a registered pension scheme is a tax-free benefit. Employer's contribution towards a registered pension scheme is a tax-free benefit. However, employees' contribution to a registered pension scheme, employees' contribution to a registered pension scheme is treated as allowable deduction. So we hold it as we get the employment income. So down here, we get what we call the employment income. Employment income. We get the employment income. So we had the figures that we have to get the employment income. So what is the employment income? 4,320,000 plus 200,000 plus 75,000 plus 48,000. Then we have plus 240,000 plus 720,000 plus again 240,000 plus 180,000, then lastly plus 135. So we repeat again, we have 4,320,000 plus 200,000 plus 75,000, then plus 48,000 plus 240,000, then plus 720,000, then we have plus 240 on insurance benefit, plus 180, then we have plus 135. So that should be 6,158,000. So we have 6,138,000. So from this, after getting this, we can get the housing benefit. So housing benefit. How do you get the housing benefit, which is taxable? So say 15% of the employment income, that is 6158, you compare with the market value or the rental value. The rental value was 120,000. Say the employer paid 120 times 12. 120 times 12. You get the two and you pick the higher. And you can less his own contribution towards rent. We less his own contribution. But for this particular question, we do not have own contribution towards rent. So 15% times 0.15, that should be 923,700. The market rental should be 120,000 times 12. That should be 1,440,000. 1,440,000. So if you compare 923,700 with 1,440,000, the higher should be 1,440,000. That is the higher. The higher should be 1,440,000. That is the higher. As we rotate the camera towards this end, we get what we call the gross employment income. We get the gross employment income. We get what we call the gross. We call it the gross employment. We call it the gross, what we call the gross employment income. The gross employment income. So that should be 6 million plus 1 million for 6,158,000 plus 1,440,000. So what do you have? The gross employment income should be 7,598,000. 7,598,000. So we less what you call less allowable. What you call allowable deductions. We less the allowable deductions. We less the allowable deduction. In this case, the only allowable deduction we have is contribution to pension. We do not have contribution to OSP. We do not have mortgage interest. We do not have direct expenses. So we have the only allowable deduction, we say contribution to a registered pension scheme. Contribution to a registered pension scheme. So what do we take to the contribution to a registered pension scheme? Whatever we take is employees' contribution towards that. That is basically 7.5% times the basic salary, which is 4,320,000. You compare with 30% of the gross employment income, which in our case is times 75, 7,598,000, which is 7,598,000. And then we have a set limit for the pension. So set limit per annum for the pension is a figure of 240. So we can get 7.5%. 7.5% times 4,320,000. You divide by 100 so that this should be 324. This is 324. That on those items, so as we were saying, we say that for contribution to a registered pension, when an employee contributes to a registered pension, we call it allowable deduction, meaning that we can use it to less our taxable income. So three things that we compare, as we repeat to emphasize on what we had said. We say the actual contribution that is made by employee, that is 7.5 of the basic. So 7.5 of the basic, that should be 7.5 times 4,320,000, we get 324. Then we get 30% of the gross employment income, which is 30% of 7,598,000. We get 2,279,400. Then we have the set limit. So we look at those three things and we compare the lower. We get the lower. We get the lower of the three. So 324, 2,279,400, and 240. The lower should be 240. And we were saying, if you look at the habit of the taxpayer, basically the taxman, not the taxpayer, the taxman. For those benefits, look at even the housing benefit, look at even other benefit in terms of motor vehicle benefit. You find that the taxman, when it comes to taxing you, they want to tax you on the highest benefit. And when it comes to those things that basically needs to reduce your income, they want to pick the lower. So when you have that, we have what you call, when you less that, we have what you call the net employment income. We have what you call the net employment income. So when you less that, that was 7,598,000, then minus 240, that one we have basically 7,373, that is 7,358,000, 7,358,000, 7,358,000. So then we had add other taxable investment income. Other taxable investment income. Other taxable investment income. So those are investment income that are basically subjected to further taxation. If you look at the additional information, as an emphasis again, we say that one of it is gross rental income. Gross, what do you call the gross rental income? And you say from commercial. Because when you talk about residential, they're subject to withholding currently in 24 at 7.5. That is the gross rental from commercial, income from commercial. The word is commercial property. So that we had that subjected to further taxation. 1.2. So then we have dividends from some cooperative. Dividends from some cooperative society. Dividend from some cooperative society. We call it non-qualifying dividends. Non-qualifying dividends to mean that the 15% withholding tax is not final. We're still subjected to further taxation. But remember, we subject it at gross. We say we subject it at gross. Remember, 85,000 was 85%. So the gross should be 100 over 85 times 85,000. So that is 100,000. That is basically 100,000. Then we say that interest from Union Bank. When individuals receive interest from a bank or insurance company, we call them qualifying interest. We basically call them qualifying interest. We're saying that 15% withholding tax is final. We don't subject them to further taxation. And lastly, we have another source of income, that is consultancy. We call it the consultancy fee. So consultancy fee was basically net. If residents are given a consultancy fee, we know that there is going to be 5% withholding. So net is at 95. What about gross when you're adding it? The gross should be 100 over 95 times 114. So this should give us 120 as we had earlier done in the working. So up to that point, as we pick our curve, we say that total, we get what we call the total taxable. We call it total taxable income. We call it the total taxable income as a summary of that, total taxable income. So we had the net employment income plus 1.2 plus 100,000, then say plus 120,000. So that should be 8,778,778,000. So that is how we determine, how we compute taxable income for Taliza Bara for the year ended 31st December 2023. That is how we basically sort that particular question. I want us to proceed to Roman 3. That is the last question in 3 to proceed in Roman 3. To proceed basically in Roman 3. Roman 3. Determine the tax. Roman 2, sorry. Roman 2 is we basically told to determine the tax payable, tax payable. Determine the tax payable. Determine the tax payable. That is Roman 2. Determine the tax payable. Very important is to grab the tax table. Very important is to grab the tax table. Very important is to grab the tax table. So on the tax table, we need to understand that this is an annual. So we have what we call monthly, and then we have annual. What do we use in this particular question? Because this is an annual income, we are basically going to use annual. So on annual, we are being told that the first 288,000 we tax at 10%. The first 288 we tax at 10%. That should be 28,800. That should be 28,800. So at 10%, we get 28,800. So then we're being told that between 288 to 388, we tax at 25%. So what is the difference between 388? 388 minus 288. Minus 288, that should be 100,000 times 25%. We get that to be 25,000. We get that to be 25,000. And the next tax bracket, that is the third one, between 388 and 6 million, we tax at 30%. We tax at 30%. Between 6 million and 388, we tax at 30%. We get the 30% of that. So what is the difference? When I have 6 million minus 388, so that is 5,612 times 0.3, which is 30%. That should be 1,683,600. 1,603,600. Then we're saying that from 6 million to 9.6. If you look at our total taxable income, we can note total taxable income up here, total taxable income. From the question from part 1, we know that is 8,778,778,000. So total taxable income does not go past 9.6. So we'll only fall at 32. So above 6 million, that we have the total being 8,778,000 minus 6 million, and then we get times 32, it gets 32.5%. What is the tax on that? So I have 8,778,000 minus 6 million. We have 2,778,000 times 32.5. Then we divide by 100. So that should be 902. We have 902,850. So at this point, we have what you call the gross tax. We get the gross tax. So the gross tax, we have 28,800 plus 25,000 plus 1,683,600, then plus 902,850. So the gross tax in this is 2 million. We have 2,640,640 to 50. 640 to 50. Then you say less tax credits. Less the tax credit. So remember, when this person had stayed for more than 183 days in a year, that automatically qualified to be a resident. So he is entitled to what we call a personal relief. So we have one of the tax credit is personal relief. So personal relief is a figure of 28,800. You look at, if you look at the tax table, Down there, after those monthly, annual, personal relief per year, per month is 2,400, per year is 28,800. Then the next we have what we call payee, the taxes that were being paid on basic salary. We were told 50,000. So 50,000 times 12, that should give us 600,000. That should give us 600,000 as personal relief. Then we have the next. The next we have what we call now insurance relief. When you're contributing insurance relief, we have the insurance relief. If you're contributing to a life cover or education cover, you're entitled to a relief. We say that relief is 15. Remember, the employer was contributing for him towards a life cover of 240. So 15% times 240 you compare with the set limit for the insurance is 60,000. So you pick the lower. So 15%, we have 15%, 0.15 times 240 times 240, that is 36. So 36, if you compare with the set limit for insurance per annum is 60,000, the lower is 36. So we less the 36. We less the 36. Then we go to withholding. Withholding on dividends. On dividends, div from Samco. Samco Cooperative. That was Samco Cooperative, which is a non-qualifying dividend. So 15%, that was deducted times 100,000. The gross was 100,000. So that should be 15. That should be 15. So then we have a withholding that was also deducted on consultancy. On consultancy, that should be 5% times 120. 5% times 120. So what is the 5% times 120? 0.05 times 120 times 120. That should be 6,000. 6,000. So the net tax payable, net tax payable, net tax payable, the net tax payable. So the net tax payable, we have the gross taxable, the gross tax 1,954,450. So that is the net tax payable. We can repeat it, 2,640,250 minus 28,800 minus 600,000, then minus 36,000 minus the 2, that should be 21,000. So the net tax payable is 1,954,450. That is the net tax payable. And as we conclude this question, this basically question 1 was about 12 marks. What is the approach? Very important for learners to understand. You need to be very keen on the entries. Like if you're looking at this, the first entry was at 4,320,200,000, 75,48. Be very keen on these entries. Very keen on those particular entries that we have. If you look at these entries, not the marks, but look at those entries. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So we have about 14 entries. So in order for you to be good in this question, you need at least 12 entries to get those 12 marks. You need at least those 12 entries to get the 12 marks. On this other part, you ask, determine the tax payable. That is basically subject, as we rotate that, subject to the total taxable income. That is what determine the tax payable. And as we get to this point, we look at the entries that we have. When you're getting the gross tax, these are entries, these are entries. These are entry. We also have an entry here, an entry here, an entry here, and an entry here. So particularly when you look at this 1, 2, 3, 4, 5, 6, 7, 8, 9. So any 6, you can have any 6 times a half. That should be able to give you 3 marks. And you should be able to get or solve that particular question exhaustively.
Greetings and welcome to the lesson. Today we are going to revise the last question, August 2023. The paper is Advanced Auditing and Assurance, August 2023. The paper reads as follows. Question 5A. X-Link Commercial Bank is a middle-sized bank with a large pool of customers seeking credit. The bank's credit activities mainly comprise the following. 1. Origination and disbursement. 2. Monitoring. 3. Collection. Required. As the lead auditor of the bank, prepare a checklist of the key internal controls that you would expect under each of the following 3 functions, under each of the 3 functions above. That's part A of the question. The bank's credit activities mainly comprise the following. 1. Origination and disbursement. 2. Monitoring. 3. Collection. As the lead auditor of the bank, prepare a checklist of the key internal controls that you would expect under each of the 3 functions above. The functions are origination and disbursement, monitoring, and collection. Checklist of internal controls. Checklist of internal controls. Checklist of internal controls. Checklist of internal controls. Under each of the 3 functions. And the first function is origination. Origination. Originating. And coming this is a bank that is providing credit. X-Link Commercial Bank is a mid-sized bank with a large pool of customers seeking credit. Now, if a bank has a large pool of customers who are seeking credit, what are some of the activities involved at the origination stage? Of course, definitely, candidates, before a bank advances money to any customer, there has to be what we call credit approval process. Credit approval process. Credit approval process. There has to be controls at that stage. The bank should have clear and documented credit approval policies and procedures. Clear and documented. Clear and documented credit approval processes. The bank should have a clear and documented credit approval processes or policies and procedures. Let me say policies and procedures. Policies and procedures. That is a control. Clear policies and procedures in regard to credit approval. Segregation of duties. That is another control. Segregation of duties between credit origination, approval, and disbursement. Okay? Segregation of duties is an internal control between origination, approval, and disbursement. The one who is originating the transaction should not be the one approving and should not be the one doing the disbursement. Another control is adequate credit risk assessment. Adequate credit risk assessment. The bank should have adequate credit risk assessment. Regular reviews. There ought to be regular reviews. This is reviews and updates of credit policies and procedures. These credit policies and procedures ought to be reviewed regularly. You understand? So currently we are discussing the checklist of the key internal controls that you would expect under each of the three functions. And the first function is origination. We can also mention customer controls in relation to customer onboarding. Customer onboarding. The bank should have a robust customer due diligence. Customer due diligence. Customer due diligence. This is still at the origination. Before admitting any customer, the bank ought to have policies in place to carry out customer due diligence. Then know your customer procedures. E.g., know your customer procedures. Before advancing credit to any of the customers, the bank should carry out due diligence on every customer. The bank should verify the identity and financial information regarding every customer. The customer should also be viewed at from the point of view of compliance with the anti-money laundering, counter-terrorism, financing regulations, and so on. Customer due diligence, that is a control at the origination. Know your customer procedures will be applied to every customer at the origination stage. loan documentation. There are also controls in relation to loan documentation. The bank ought to have what we call a standardized loan documentation to ensure completeness and accuracy. And that should include timely and accurate preparation of loan agreements and security documents. Accurate preparation of loan agreements. That is part of the loan documentation. Standardized. Standardized. That means that there ought to be uniform loan documentation. You understand? That is a control. Standardized loan documentation to ensure completeness and accuracy. Accurate and complete loan covenants. The agreement between the bank and the customer should be accurate, should be complete, should be timely and accurate. And the loan and covenants also, we also have security, because at times when the customers are required to provide security, so there ought to be proper documentation in relation to the agreements and also the security documents. Security documents, loan agreements. Proper authorization and approval. This is still at the origination stage. There ought to be proper authorization and approval. Proper authorization and approval of loan documentation. Proper authorization and approval of loan documentation at the origination. So these are some of the controls, internal controls at the origination. Let's move on to the monitoring stage. Monitoring. 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 Now, what are some of the controls? After the origination stage, this is origination and disbursement. This is where we have the credit approval process, the customer onboarding, the bank has conducted customer due diligence, the bank has ensured that it has accurate loan covenants and accurate security documents, and money has been disbursed to a customer. Now we have the monitoring of the loan. The bank has to monitor. After giving the customer money, the bank cannot just sit back. The bank has to monitor the performance of the customer in relation to the repayment of the loan, depending on the loan agreement or covenant. So what are some of the internal controls that we should expect at the monitoring? One is loan portfolio management. Loan portfolio management. Loan portfolio management. There ought to be regular monitoring of loan performance and risk ratings. All right, regular monitoring of loan performance. Regular monitoring of loan performance, regular monitoring of loan performance and risk ratings, regular monitoring of the risk ratings. The bank should also identify and classify any problems that are likely to arise. Do you understand? Timely identification and classification of problem loans. Timely classification, identification and classification of problem loans. Those loans, or the customers who do not repay the loans on depending on the loan agreements, they ought to be identified in time, and classification also ought to be done. You understand? The bank should ensure that there is effective early warning signals and triggers for loan reviews. That's a control. Another control is regularly monitoring of compliance with covenants. Regular monitoring of compliance with covenants. The bank, after disbursing loans to customers, should regularly monitor if the customers are complying with the loan covenants or agreements. Another control is effective enforcement of covenant remedies. Effective enforcement of loan remedies or covenant remedies. So we are identifying the controls during monitoring of loans after the loans have been disbursed to the customers. The bank, the last point here is that should effectively enforce covenant remedies. Collateral management is another control. There ought to be adequate procedures for valuation, for perfection, and also monitoring of collateral. The bank ought to have regular reviews and updates of collateral valuation models. Collateral management. Adequate procedures for valuation. This is A, B, C, collateral management. Adequate procedures. Adequate, let me just say, adequate valuation procedures. Collateral, currently, this is the security that the customer gives to the bank. The bank should regularly collateral or securities. Do you understand? Then collection list of internal controls during collection procedures. Is one control, collection procedures. Collection procedures. The bank ought to have clear and documented collection policies and procedures. There also ought to be a segregation of duties between loan servicing, collection, and recoveries. Segregation of duties. Segregation of duties should be enforced. Segregation of duties between loan servicing, that is one activity. We also have collection and recoveries. The officers who service and those who help in loan servicing and collection and those who do the recoveries should not be the same. There ought to be segregation of duties. Collection procedures. Overdue accounts. How about overdue accounts? There ought to be timely identification and escalation of overdue accounts and regular follow-up with borrowers to encourage timely payments of the loans. Regular follow-up with borrowers. Regular follow-up with borrowers. Collection. Candidates, there ought to be controls. The bank should have controls to ensure that there is regular follow-up with the borrowers. Regular follow-up with the borrowers to encourage timely payments. There also should be effective legal and recovery actions. Legal recovery actions. Legal recovery actions. Effective legal and recovery actions. The bank should have procedures on how to recover undue or overdue accounts. You understand? So candidates were to give at least 3 controls under each of the following categories: origination and disbursement, 3 controls; monitoring, 4 controls each. Origination and disbursement, 4 controls; monitoring, 4 controls; collection, 4 controls. That would earn the 12 marks. Then part B of the question reads, the government of your country has recently introduced performance contracting in the public sector with the objective of improving service delivery to the public. This has been largely achieved by ensuring the top-level managers are accountable for results and ensuring that resources are focused on attainment of key national policy priorities of the government. The audit firm has recently won a tender to audit the reliability of feedback provided by the state corporations on achievement of performance contracting targets required. Describe the key audit procedures you would undertake to achieve the above audit objective. So what is the audit objective? Your audit firm has recently won a tender to audit the reliability of feedback provided by the state corporations. That's the objective. So the government has recently introduced performance contracting. Performance contracting. What is performance contracting? Performance contracting in the public sector. What is that? Now, performance contracting in the public sector is a management tool that involves a formal agreement between the government and government agencies or individuals. So it is an agreement between the government on one hand and a government entity or a public agency or even individuals in government. So the agreement outlines specific performance objectives or targets or even timelines, along with the consequences for meeting those targets or the consequences for failing to meet those targets and timelines. So it is an agreement between the government and the entities within the government, an agreement between the two. And that agreement specifies performance objectives, targets, and timelines. Objectives, targets, and timelines. Because the government has employees, has agencies that ought to perform certain tasks. We read here that the government of the country has recently introduced performance contracting in the public sector with the objective of improving service delivery to the public. Service delivery to the public. Service is delivered to the public through people, through agencies. These are the agencies I'm talking about that enter into an agreement or a contract between themselves and the government. And these agreements, we are calling them performance contracting. They outline the specific performance objectives, targets, and timelines, along with the consequences for meeting or failing to meet those targets and objectives, and also the timelines. They come also with the consequences for failing to meet those targets. Do you understand? So first of all, you have to understand what performance contracting is. Otherwise, you may not be able to answer the question. So your audit firm, you are not the auditor. Your audit firm has recently won a tender to do what? To audit the reliability of feedback provided by state corporations on achievement of performance contracting targets. So you see, the government has agencies, the government has state corporations. These state corporations are required to provide feedback, which is based on the performance contracts, the targets and all that, to check if they have they are meeting the targets and the timelines. So you've been contracted as an auditor, right, to audit the reliability of the feedback that is provided by the state corporations. So you are required here to describe the key audit procedures. The key audit procedures you would undertake to do what? To achieve, you would undertake to achieve the above audit objective. You understand? You are to assess the reliability of feedback provided by state corporations on the achievement of performance contracting targets. So what are the procedures that you should conduct procedures. Now, step number 1, this is part B, procedures. You have to describe the audit procedures. Now, the first audit procedure is to review the performance contracting framework. Review of performance contracting framework. Review of the performance contracting framework. You have to understand the framework. Understand because you're coming in as an outsider. Before you do anything else, before you do anything, you have to first of all understand the framework. Gain a thorough understanding of the government's performance contracting framework, including its objectives, the key performance indicators, and the methodology for testing or for setting targets. Setting targets. Then assess the rigor for setting standards. Assess the rigor for setting standards. For target setting or standard setting. Evaluate the process used to set targets, ensuring that they are specific, measurable, achievable, relevant, and time-bound. These standards should, in other words, be SMART. Contracting, performance contracting. What is the process? Evaluate the process used to do what? To set targets, and also ensure that the process is SMART. 3. Review the monitoring. And evaluation. You have to review the monitoring and evaluation system. You have to review the monitoring and evaluation system. Examine the systems and procedures in place for monitoring performance, for collecting data, and also conducting evaluations. You understand? That is what ought to be done in reviewing the performance contracting framework. That's the first procedure. Two, examination of performance. Examination of performance reports. That's the second procedure. And in examining the performance reports, you need to pay attention to data quality and consistency. Data quality and consistency. Assess the quality and consistency of data used in performance reports, including its accuracy, completeness, and timeliness. 2. Verification of claims. Verify the claims. Select a sample of performance claims and verify them through independent sources or even by just conducting site visits and interviews. Performance reports. Candidates are issued by the state corporations. So the state corporations are to submit reports to the government on their performance. So we are trying to describe the procedures that the auditor would undertake to achieve the above audit objective, which is to audit the reliability of feedback. The feedback is in form of reports, the performance reports. So when you audit candidates, these performance contracts, you need to verify what has been claimed in these performance reports. So first of all, we said you check for the consistency and quality of the data within these performance reports. Assess the quality and consistency of data used in performance reports. Are the reports accurate? Are the reports complete? Are they being provided on time? Then you check the claims, verify the claims. Select a sample of the performance claims and then verify them through independent sources. A state corporation may claim in the reports that it builds, say, roads. If it is a corporation that builds roads, like Kera or any other, or Kenha, they may claim that they have built 200,000 kilometers of roads in 1 month. So you may want to verify that claim. And how do you do so? You select a sample of roads and do site visits. Conduct site visits. Interview the users. Because you see, this is a government service. Okay? The government of your country has recently introduced a performance contracting in the public sector with the objective of improving service delivery. This is service to the citizens. So you can interview the citizens if, for example, the roads have been contracted as claimed by one of the state corporations. Three, you can do trend analysis of trend data. Analysis of trend data. Analyze historical performance data to identify trends and anomalies, and then you may also want to assess the reliability of reported improvements, because that could also be part of the claims here, that we've made an improvement of 15% compared to last maybe period or so. Analysis of trend data. That is examination of performance reports, data quality and consistency, verification of claims. We have analysis of trend data. You understand? 3, accountability. There's also there's a procedure in relation to assessment of accountability. Assessment of accountability. The auditor may evaluate accountability mechanisms. And we can even add here incentives. Analysis of or assessment of accountability and incentives. The auditor may evaluate accountability mechanisms. Evaluate accountability mechanisms. Assess the effectiveness of accountability mechanisms such as performance-based rewards, such as penalties, in motivating state corporations to achieve targets. Review incentive structures. That's another procedure, reviewing incentive structures. The auditor may examine the design and the implementation of incentive structures to ensure they align with the performance contracting framework and also motivate desired behaviors. This is 3. Number 4 is evaluation of the feedback mechanisms of feedback mechanisms. The auditor here should assess feedback channels. Assess feedback channels by reviewing the channels used to collect feedback from stakeholders, such as surveys, such as focus groups, social media, and so on. Evaluate feedback analysis. After receiving feedback from the state corporations, then there has to be the evaluation of that analysis. The auditor should examine the methods used to analyze feedback data and also the identification of trends and decision making. You should examine the methods that are used to analyze feedback data. This is data that is provided by the state corporations. How is it analyzed? We should evaluate how it is analyzed. Reviewing of or evaluating feedback analysis. Then after that, you can review the use of feedback. How is a feedback used? You have to do a review of how the feedback is used. You need to assess how feedback is used to improve performance. How feedback is used to identify areas for improvement and also inform future performance targets. Five, identify and assess risks. That is another procedure. The auditor should identify potential biases. Identify potential biases. You understand? You ought to assess the potential for bias in performance reporting, such as overstating achievements or even under-reporting failures. You may also want to evaluate the impact of external factors such as economic conditions, policy changes on performance outcomes. So these are 5 procedures. Candidates were required to just give 4. Given 5 procedures you would undertake to achieve the objective of auditing the reliability of provided by SEC operations on achievement of performance contracting targets. Any questions? financial statements, final accounts, and the syllabus requires to start with the financial statements of a sole trader. Financial statements of a sole trader. Financial statements of a sole Now, a sole trader, also known as a sole proprietorship, a sole trader or a sole proprietor or sole proprietorship business is a business owned and operated by a single individual. And the structure of this business is simple. It is simple to set up. It is simple to manage. But it may also come with certain financial reporting requirements. One of the key financial statements for a sole trader is an income statement, also known as a profit and loss account. Now, the profit and loss account shows the revenue earned and expenses incurred by the business over a specific period. And it is this statement that helps us to determine the net profit or loss of the business. Then we have the statement of financial position, which is also known as the balance sheet. It is a statement that presents a snapshot of the business financial position at a specific point in time. And it is through the business that we can know the assets, the liabilities, and the equity of the owner. So we are required, first of all, to cover the two financial statements of a sole trader: the statement of profit or loss and the statement of the financial position. I've just said the statement of profit and loss account. So the first statement is a statement of profit and loss account. First of all, we've defined a sole trader. Sole trader business is also known as sole proprietorship. It is a business that is owned by one individual or one person. So sole traders are required to prepare statement of profit or loss account. It is through this statement of profit or loss account that we are able to determine whether the business is making profit or is incurring loss at a specific point in time. So the statement will have revenues and expenses, just two things: revenues and expenses. Revenues and expenses. It helps us determine the net profit or loss of the business. So it will have revenues like sales, services. It may also have expenses like rent, salaries, utilities, airtime. All expenses that are incurred by the business are recorded in the profit and loss account in the process of determining the profit or loss. So it is profit or loss statement. Statement of profit or loss. Now let's look at the structure. Structure or format. Let me use the word format. Format. Let's look at the format. Now, there are two formats, candidates. The conventional, the traditional format, the T account. The statement of profit or loss may be prepared in form of a T account, where we record the revenues on the credit side and expenses on the debit side. So for a business, the first revenue would be sales. So we record here the sales. Then on the debit side, we'll have the cost of sales. Cost of sales. So here we will have the opening stock, we add purchases, if there is carriage inwards, we add here carriage inwards. Now carriage inwards is just the transportation cost on purchases. If these purchases, when buying these inventories, if any transportation cost was incurred in the process of buying these inventories, then we add it to the purchases. Then we deduct the purchases returns. Purchases returns we deduct. Now, after purchasing from suppliers, it is possible to make sometimes returns. Maybe the supplier has delivered goods that were not ordered, or has delivered goods in excess, or goods are damaged upon delivery, so the returns are made. So when that happens, then we deduct that from the purchases. Then we deduct the closing stock or closing inventory. We deduct it from the total here. So what you get down here is what we are referring to as the cost of sales. So here on the credit side, we have sales, then we may deduct sales returns. After selling, we may have returns inwards. Customers may also return what was sold to them. So when that happens, we deduct from the sales to get the net sales. So from this net sales, we deduct the cost of sales. This amount, deduct from that amount, we'll have here what we call the gross profit. The gross profit. So that account, we will close it. We come here and close. So see, we have the gross profit. If the net sales is higher than the cost of sales, we'll have here the gross profit. But if the cost of sales is higher than the net sales, then we have the gross loss. Gross loss. So that is what we call the trading account. Up to this point, we have the gross profit, which we bring down here. Gross profit. Bring it down. This is the gross profit brought down. Then, if there is any other income, like dividend, like income, like interest received, we add to the gross profit. That could be discount received. We add it to the gross profit. Then on the debit side, we deduct all expenses like salaries, rent, electricity, water, airtime, stationery. All expenses have to be debited, so that we then compare all these revenues on the credit side with the expenses on the debit side. If the total revenues exceed the expenses, then you will have the net profit. But if expenses exceed the revenues, you'll have the net loss on the credit side. Net loss. So that one we get the total and close. Get the total here and close. So that is the format of a statement of profit or loss. A T format. So the reason I'm doing this, so most of you read books, you may find some books presenting the statement of profit or loss in this format. This is the horizontal format, the T format. This is the traditional format. Today, this format is not in use. Today, if you are asked to prepare statement of profit or loss account, then you have to do it in vertical format. So here is the vertical format of statement of profit or loss, vertical format. So we'll have two columns here for the amounts, two columns. So we begin with the revenues, sales, have it there. Then there is sales returns, or returns inwards. We have to deduct sales returns from the sales to get the net sales. Net sales. Then from the net sales, we will deduct the cost of sales. Cost of sales. How do you calculate cost of sales? First, you take the opening stock, add purchases, deduct purchases returns, so you have opening stock, write it in the first column here. Purchases you add to the opening stock, purchases returns you deduct, or returns outwards. So it's known as purchases returns or returns outwards. Then of course we have the closing stock, which we deduct here. The net is a cost of sales. So what we have is the cost of sales. So this cost of sales deduct from sales to get the gross profit. Gross profit. Then we add any other income to the gross profit, like rent received. If the business has rental income, we add it to the gross profit. Discount received. So these ones we have in the first column, we have expenses here. For these are not expenses, but these are incomes. We add to that. Then we get the total income here. This is total income. Now from this total income, we deduct the expenses. Business expenses like discount allowed, insurance, airtime, and so on. So all the expenses are listed in this first column. List all the expenses, put down all the expenses, including depreciation of fixed assets. We have all the expenses here. So we take the aggregate of the expenses and deduct from the total income. So these are total expenses, deduct from the total income. So what we have here is either profit or loss. Either profit or loss, depending on the total expenses value and the total income. If the total income is higher than the total expenses, then you have profit. But if expenses value is higher than the total income, then you have the loss. So that is how to prepare a statement of profit or loss. There are two ways: the horizontal format, the vertical format. The horizontal format is a traditional format. Today, you are required to prepare your statement of profit or loss in a vertical format. Is that well understood? That is the format of a statement of profit or loss for a sole trader or a sole proprietor. Let's have a brief illustration. Let us illustrate with a question. From the following trial balance of Rehema Enterprises, draw up a trading profit and loss for the year ended 30th September 2023. I want to remind you something from that statement. From the following trial balance of Rehema Enterprises, draw up a trading profit and loss account for the year ended 30 September 2025. You can see, candidates, we are to draw the final account. Look at the board. We are to draw the final financial statements, which we said are also known as final accounts. For you to draw up the financial statements, like the one we are calling statement of profit or loss account, you must have a trial balance. It is from this trial balance that we prepare the financial statements. And for you to extract a trial balance, you must have ledgers. You must have drawn up ledgers. It is on the basis of ledgers that we prepare or extract a trial balance. And you cannot have these ledgers without the journals. We use journals to prepare ledgers. And these journals, which are also known as books of original entry or books of prime entry or subsidiary books, are prepared from source documents. And these stages, candidates, defines accounting as a process. This is the final product. But for you to come up with the final product, there are stages. And so far we've done the trial balance, we've done the ledgers, we've done the journals, we've done the source documents. So it's a process. That's why now that we are required to prepare financial statements, we are given trial balance. That's why we are reading from this question that from the following trial balance, do what? Draw up a trading profit and loss account for the year ended 30th September 2015. So accounting is a process, and these are the main stages in the process of accounting. So the current topic is financial statements of a sole trader. In our next topic, we'll be learning how to prepare the financial statements of a partnership. Then we'll move to the financial statements of a company. We'll go to the financial statements of a manufacturing entity. We'll move to the financial statements of a not-for-profit organization. So let's prepare this statement. Now, in preparing financial statements, we must begin with the name of the entity. The statement of trading profit and loss account is being prepared for the company known as, or the business. Sole proprietor is Rehema Enterprises. So at the top here, we must have Rehema Enterprises. Then the name of the statement. The name of the statement is Trading Profit and Loss Account. Trading Profit and Loss Account for the year ended December 2015. So you must have the date at the top and the name of the enterprise. So you'll prepare this statement in a vertical format. So we're going to have two columns for the amounts. Are the amounts in thousands? Yes. So we come to the revenues. What is the first revenue there? We go through the question. On the credit side, the revenues balances will always appear on the credit side. The revenues will always appear on the credit side of the trial balance. And the first revenue there is sales. Sales 18.6 million. Do you have sales returns? If there are sales returns, then the returns will appear on the debit side. Do we have returns inwards? Yes, the fourth item there, return inwards. We deduct return inwards, also known as sales returns. The amount is 205,000. Deduct from sales, you get the net sales. How much is it? From net sales, we deduct the cost of sales, beginning with the opening stock Opening stock, we have the opening stock. The first item there is the opening stock 2368. Add purchases. Purchases 11874. 11874 is the value for purchases. Do we have returns outwards? Yes, returns outwards, also known as purchases returns. Return outwards. Return outwards will always appear on the credit side. 322 we deduct. If there is any closing inventory, yes, below the trial balance we have closing inventory. The closing stock is 2946. We deduct. What we get here is a cost of sales. We deduct the cost of sales from the net sales to get the gross profit. So give me the net 18,370, 18,395. 18,395. Net sales 109.74. 109.74. How about the gross profit? 74.21. Now, candidates, up to that point, that is the trading account. Trading account. The last item in a trading account is either gross profit or gross loss. Either gross profit or gross loss. That is up to that point. The trading, we've done the trading account and we've seen that there is a gross profit. Now on this gross profit we add any other income. If you want to know that this business had any other income, check on the credit side of the trial balance, because income accounts always have credit balances, and we see there is no any other income. So we move straight away to the expenses. We deduct expenses. We check if there were any expenses, and all expenses will always appear on the debit side of the trial balance. And looking at this trial balance, we have carriage outwards. Carriage outwards, that is just transportation costs. Carriage outwards, that is an expense. Carriage outwards. Carriage outwards is 200. Then we move down the debit column. Debit column, we have returns inwards, returns outwards, purchases, sales, salaries. That is an expense. Salaries and wages. Salaries 3862. That's the value for salaries, followed by rent. Rent is the next expense, 304. After rent, we have insurance. Insurance is an expense, 78. Mortal expenses. Mortal expenses, 664. To mortal expenses, we add the office expenses. Office expenses. Office expenses, 216. The next expense there is lighting and heating. Lighting and heating expense. Lighting and heating expense, 166. 166. Then there is general expenses. General expenses. General expenses is 314. That is general expenses, 314. I don't see any other expense here because below general expenses we have premises. That is an asset. Motor vehicles, that's an asset. Fixtures, that's an asset. Data, that's an asset. Then there is creditors, that's a liability. Cash is an asset. Drawings is a drawing. Capital is just capital. So give me the total expenses. Deduct the total expenses from the income or the gross profit. Then the last item here is either net loss or net profit. So give me the total expenses. 5804. 5804. 5804. Deduct 5804 from 7421. What is the net profit or net loss? If it is 5804, then this is a net profit. John says 1617. So we put two double lines there. 1617. That is the net profit. So that is how to prepare a statement of profit or loss. And welcome to the lesson. We are going to answer question 1. This is a question that is in two parts, A and B. Part A reads, CMP Limited is a production company that employs 50 workers. The company has the following payroll procedures. 1. The factory foreman interviews applicants, and on the basis of the interview, either hires or rejects them. When applicants are hired, they fill in an employee's withholding exemption certificate and forward it to the foreman. The foreman indicates the hourly rate of pay for the new employee in the W4 form and then forwards it to a payroll clerk as notice that the worker has been employed. The foreman verbally advises the payroll departments of any adjustments to the hourly rate of pay. Number 2. A supply of black time cards is kept in a box near the entrance to the factory. Each worker takes a time card on Monday morning, fills in his name and notes in pencil their daily arrival and departure times. At the end of the week, the workers drop the time cards in a box near the factory door. Number 3. Each Monday morning, the completed time cards are taken from the box by a payroll clerk. One of the payroll clerks then records the payroll transactions using a computer system which captures all information for the payroll journal as calculated by the clerk and automatically updates the employees' earnings records and general ledger. Employees are automatically removed from the payroll when they fail to return in a time card. 4. The payroll checks are manually signed by the chief accountant and given to the foreman. The foreman distributes the checks to the employees and arranges for the delivery of the checks to those who are absent. The payroll bank account is reconciled by the chief accountant, who also prepares the various payroll tax reports. Required. Discuss 6 deficiencies in CMP Limited's internal controls with the associated risks for each deficiency. So that is the question. There are 4 procedures. We are required to discuss 6 deficiencies in CMP Limited's internal controls with the associated risk for each deficiency. Can I hear from you, members? There is lack of segregation of duties. That is true. This question was borrowed from August. This is August 20. August 2023. Question 1. A. Deficiencies and associated risks. So you can see the question is allocated 12 marks. So candidates were required to give deficiencies and risks. So Roman 1, you have to give first of all one deficiency, then you give the associated risk to earn 2 marks per point. So like in point 1, you should indicate the deficiency. Like Sue here says, lack of segregation of duties. That is a weakness or deficiency. So what is the associated risk of lack of segregation? This is segregation of duties. Because you've seen the foreman candidates here. The factory foreman interviews applicants on the basis of the interview, either hires or rejects them. When applicants are hired, they fill in an employees withholding exemption certificate W4 form and then forwards it to the foreman. So you see the foreman is interviewing. When they fill in the form, they submit the form to the foreman. And you can see the foreman again indicates the hourly rate of pay for the new employees. He's hiring them. They are giving him the forms. He's determining the hourly pay. Do you see that? Then the foreman again verbally advises the payroll department of any adjustments to the hourly rate of pay. So the foreman has too much control over the hiring process, including approving hourly hours and distributing the checks. You saw in note number 4, the payroll checks are manually signed by the chief accountant and given to the foreman. So that is a weakness. There is lack of segregation of duties. But what is the risk that is associated with lack of segregation of duties in the case of CMP Limited? Too much control over these activities, candidates, increases the risk of unauthorized hiring. The foreman can decide to hire employees without any authorization from the company. Do you see that? There could also be risk of errors in hourly hours or pay rates. There could be risk of errors errors, because you see, is only one person doing many tasks. When you have segregation of duties, a worker can check the work of another one and identify any errors. There is a risk of potential theft of payroll fraud. So there are many risks associated with the lack of segregation of duties in relation to this company. Candidates are just to give a deficiency and the risk to earn the 2 marks. Now give me the second deficiency. There are many risks, and deficiencies, candidates. If you are to read, almost every sentence is a deficiency here. In note number 2, we read that a supply of blank time cards is kept in a box near the entrance to the factory. Each worker takes a time card on Monday morning, fills in his name and notes in pencil their daily arrival and departure. That is a deficiency. There is weak control over timekeeping. Weak control over timekeeping, because the workers are self-recording their time, which can lead to inaccuracies and potential fraud. If you tell workers to just fill in the time they came in without any controls, then you can be sure there will be inaccuracies. Weak control over timekeeping. That is a deficiency. Employees self-record their time. Employees self-record their time. That is a weakness. And we see they are even recording in pencil. That tells you that the pencil tells you that it's very easy to tamper with the record. You can rub off what has been written in pencil very easily. You see that? That is a weakness. Weak control over timekeeping. Deficiency is that employees self-record their time, which can lead to inaccuracies and potential fraud. Risk. What is the risk of weak control over timekeeping? What is the risk of employees self-recording their time? Here, candidates, there is a risk of errors in calculating errors. Risk calculating hours. Risk of errors in calculating work hours. There's that risk that there will be errors because employees are recording their time without any control, without any check. No one is counter checking, because ideally you would have someone else recording their time if there is no automated system where employees can check in and their data is captured electronically. You see that? Which could lead to incorrect pay. Which could lead to incorrect pay. Because payment is made on the basis of hours. So if the hours are inaccurate, then the pay will also be incorrect. That is the risk, which could also lead to overpayments. Okay, let me write that. And potential overpayments. That is the second deficiency and associated risk. You are identifying candidates' risks. Discuss 6 deficiencies. Have you come across any other? Incomplete or lack of documentation. I'm summarizing from what she has said. Incomplete documentation. That is a deficiency. So what is the risk of incomplete documentation? Risk of increase. And make sure you write candidates' risk so that it's clear. Because the question is deficiencies and associated risks. So when you are giving a deficiency, then you need to indicate that below is the risk. So you have to show the deficiency and the risk. The deficiency and the risk. The deficiency and the risk. What is the risk of having incomplete documentation? There is increased risk in errors. Increased risk of errors. Just as she says that the risk here is just errors and unauthorized changes, or even deliberate manipulation of pay rate. There is that risk of deliberate manipulation of pay rates. That's another risk. Deliberate manipulation of pay rates. Because there is no proper documentation, an employee can say, this is what I had, but in the back of the motive is to deliberately manipulate the pay rate, because there is that deficiency of incomplete documentation and even authorization. So Sue, before Sue, I can see here it says risk, insufficient and inappropriate evidence about the adjustment. So then says possibility of ghost workers, misutilization of funds to pay workers. Is that a risk, Sue, or is it a deficiency? When you say possibility of ghost workers, we are on the 4th deficiency. So possibility of ghost workers, is that a weakness or is it the effect of a weakness? Because it sounds like a risk. When you say misutilization of funds, that is a risk. I don't think it is a deficiency. It looks like an effect. Now, candidates, when we are talking of internal control system, always remember the control on review. You see, the work of these employees is not reviewed. No one reviews the work of another. There is no approval of even the payroll. So when you are given a question like this one, there are those controls that you all know, which should be in your mind. So you should be referring to what is in your mind with what is happening in a company like this one. You can see we have here a production company that employs 50 workers. So we're given the payroll procedures. We all know the controls that are required to be in place over any payroll. So one of the controls should be in relation to review and approval of the payroll. Does that happen in this company? No. So that is a weakness. Inadequate review and approval. There is inadequate review approval of the payroll. Nowhere do we read that there is an employee who approves. We read in note number 4 that the payroll checks are manually signed by the chief accountant and given back to the foreman. Then the foreman distributes the checks. There is no where we read that these procedures are reviewed by any other officer of the company. There is no independent review and approval of the payroll. There is no independent review of the calculations. There is no independent review of the journal entries. So what is the risk that is associated with inadequate review and approval of the payroll? And to answer that question, you can first ask yourself a question: why do we monitor? We monitor, we review so that we can identify if there are errors, if there is any fraud, if there is any unauthorized payments. So the reason why this company needs another officer to review the work of the foreman and the accountant is to identify errors or fraud or even unauthorized payments. So the risk here is a risk of errors, fraud, and unauthorized payments. Errors, fraud, and unauthorized payments. There's the risk of errors. If there is no review, there is no monitoring. If there is no independent review, then there is increased risk of errors, fraud, and unauthorized payments. It's that simple. That is number 4. Give me number 5. The fourth weakness. We read in the last part of this question that the payroll checks are manually signed by the chief accountant and given to the foreman. The foreman distributes the checks to the employees. The foreman distributes the payroll checks to the employees, including arranging delivery to absent employees. That is a deficiency. The foreman does what? Is responsible for distributing payroll checks. Foreman is responsible for distributing payroll checks. What is the risk associated with that deficiency? He even arranges for delivery to absent employees. What is the risk? Don't you see candidates that can allow the foreman to withhold or misappropriate checks, which may lead to disputes with the employees? The risk is misappropriation of checks by the foreman. There's that risk, misappropriation of checks, because he is handling the checks, he is distributing the checks, he is even withholding checks for employees who are absent. The foreman distributes the checks to the employees and arranges for the delivery of the checks to those who are absent. That increases the risk of misappropriating the checks, potentially leading to disputes with employees or even payroll fraud. There is the risk of payroll fraud. That is deficiency and risk number 5. You understand, candidates? Now you notice from what we've read, candidates, there is no mention of strong access controls for the payroll system, because here we are given information. The company has the following payroll procedures: a strong internal control system over the payroll must have strong access controls for the payroll system, such as passwords, protection, user restrictions, and so on. It's not part of these procedures. The company has the following payroll procedures. There is no mention of strong access controls. Lack of strong access controls, and these are controls to the payroll system. What is the potential risk associated with this lack of access controls? The risk is simple, candidates: unauthorized access to the payroll data. Unauthorized access to the payroll data. Because there is no mention of strong access controls, and there is a risk of unauthorized access to the payroll data, and even potential manipulation. And potential manipulation. Anyone can manipulate the payroll data. Is that risk because there are no strong access controls. That's it. These are 6 deficiencies and 6 risks. So let's move on to the part B of the question. You are the auditor of Flower Mint Limited, a company engaged in growing and exporting flowers. Assume that when you arrived at your client's office on 11th January 2023 to begin the audit for the year ended 31st December 2022, you discover that the client had been drawing checks as creditors' invoices became due, but not necessarily mailing them. Drawing checks as the invoices became due, but not necessarily mailing them. That means that the checks are written by the company in favor of creditors, but they are not mailed to the creditors. Because of working capital shortage, some checks may have been held for 2 or 3 weeks because of working capital shortage. So the company didn't have enough working capital. So instead of paying the creditors money, they withheld that money so that they can meet their short-term needs for 2 or 3 weeks. Please understand that as we move on. The second paragraph is that the client informs you that mail checks amounting to 27.6 million were on hand as at 31st December 2022. He says that these December 2022 dated checks had been entered in the cash disbursements book and charged to the respective creditors' accounts in December because the checks were pre-numbered. Heavy sales collections permitted him to mail to the checks before your arrival. The client wishes to adjust the cash balance and accounts payable as at 31st December 2022 by 27.6 million because the cash account had a credit balance. The client is also reluctant to reflect an overdraft in the financial statements. This always happens, candidates, in practice, is it not so? Required, Roman 1, prepare a detailed audit program indicating the procedures you would use to satisfy yourself of the accuracy of the cash at bank balances on the client's financial statements. Roman 2, discuss the propriety or otherwise of reversing the indicated amount of outstanding checks as at 31st December 2022. So you can see, with a question like this one, you have to read very fast and answer the questions, because you see they are just 5 marks and 3 marks. So let's look at it again. You are the auditor of Flour Mint Limited, a company engaged in growing and exporting flowers. Assume that when you arrived at your client's office on 11th January 2023. So you arrived, the auditor arrived. Let's analyze the question. Arrival of auditor. We are given the date. Assume that when you arrived at your client's office, you are the auditor. This is 11th January 2023. To begin the audit for the year ended 31st December 2020. So, year end is December 2022. So you arrived in 2023 January to audit the December 2023 records. And you discover that the client had been drawing checks as the creditor's invoices became due, but not necessarily mailing them. So the records show that the auditors have been paid, but in reality they have not been paid. On paper they are paid, but they have not received the money. So the company has a working capital shortage. And what does the client tell you as an auditor? The client informs you that unmailed checks amounting to 27.6 million were on hand as at 31st December 2022. So at this date, the end of this accounting period, we have 27.6 million shillings worth of checks. So the checks have been drawn. They are still within the company, but the creditors' accounts have been debited. They were on hand. So he says that these December 2022 dated checks had been entered in the cash disbursement book and charged to the respective creditors. So the creditors were paid. The creditors were paid. The creditors were paid. Balance, then pay, you debit. That means that the balance sheet does not have these creditors. Is that not the effect? had been entered in the cash distribution because the checks were pre-numbered. Heavy sales collections permitted him to mail the checks before your arrival. Do you see that? So before you arrived here, you can see the date is 11th, just before 11th. In 2023, it tells you that the checks were disbursed. Do you see that? Then in the third paragraph, we read that the client needs to adjust the cash balance and payable and accounts payable as at 31st December 22 by 27.6 million because the cash account had a credit balance. The credit account had the cash account had a credit balance. That is abnormal. It is abnormal because in practice there is no way you can have a credit balance on the cash account. The client is also reluctant to reflect an overdraft in the financial statements. Have you understood the problem? Members, have you understood the problem? First of all, understand the problem. Where is Hilary Sue? Isha? Isha, have you understood the problem? Have you understood the problem? Say how to understand the problem. Aisha says yes. We always say a problem well defined is a problem half solved. So prepare a detailed audit program, and these are just 5 marks. Indicate the audit procedures you would use to satisfy yourself of the accuracy of the cash at bank balance audit program. These are just procedures, audit procedures, audit program to satisfy yourself. Now, to satisfy ourselves or yourself of the cash at bank balance, the auditor ought to perform certain procedures. One is confirmation of bank balances. Confirmation of bank balances. You have to do a confirmation of bank balances. You have to obtain bank confirmation letters directly from the client's banks, then verify the accuracy of the bank reconciliation at the end year, because the company is required to have done a bank reconciliation at the end of the year. So you need to check if the company reconciled the cash at bank balance with the cash within the business, because the bank statement shows the transactions that were carried out at the bank. The cash book also has a bank column. So the auditor has to obtain, first of all, confirmation letter directly from the bank. They use that confirmation letter to verify, to do a verification, to verify the accuracy of the bank reconciliation as at the end of the year. The auditor, in other words, or furthermore, has to reconcile the bank statements to the general ledger. That is a procedure. So because here, candidates, we are talking about bank balances. You can only assure yourself, you can only satisfy yourself of the accuracy of the amounts shown in the books of this company by seeking confirmation directly from third party. The bank here is a third party. The second procedure is to review the bank reconciliations. The company must have bank reconciliation. So the auditor should verify the accuracy of the outstanding checks, because when you do a reconciliation, you can know the outstanding checks, the unpaid checks. Okay, what is the amount of the outstanding checks that then inspect a sample of the checks that have not been honored or the ones that have been cancelled to ensure proper authorization and endorsements. In carrying out or reviewing the bank reconciliation, the auditor may also review bank charges and interest income for accuracy and appropriateness. 3. Examination of cash transactions. That is a procedure that can be done by the auditor to examine cash transactions. The auditor can test a sample of cash receipts and disbursements for proper authorization, recording, and posting to the general ledger. Then verify the cutoff of cash transactions at the year end. You understand? Examination of the cash transactions may also involve reviewing bank transfers and electronic fund transfers for accuracy and completeness. Review bank accounts. The auditor may also just choose to review the company's bank accounts. Identify all bank accounts. Alright, first of all, you identify all the bank accounts maintained by the client. Then ensure that all bank accounts are properly reconciled. All bank accounts, in reviewing the accounts, should be reconciled. The auditor has to confirm that all the bank accounts have been reconciled. Evaluate internal controls is yet another audit procedure or program. Evaluate internal controls. Assess the adequacy of internal controls over cash receipts and disbursements. And then evaluate the segregation of duties and access controls for cash transactions. The auditor may also review the procedures for reconciling bank accounts and resolving discrepancies. Consider unused transactions. The auditor should consider unusual transactions by investigating any unusual or large transactions, such as large withdrawals or large deposits. You understand? So there are many audit programs, and this was just to give 5. Perform analytical procedure. Compare the current cash what with the prior periods. That is a good point. Perform analytical procedures and then compare the current cash and bank balance with prior periods. Any other point? Any other point? There is the cutoff procedures also. The auditor can also assess cutoff procedures. And just to support what Aisha has said, the auditor can confirm that checks dated in December 2022 were recorded in the correct accounting period. That is what we are referring to as cutoff. All right. Assess cut-off procedures. The checks for December 2022 should be related to December 2022. They should not be recorded in January 2023. Assess cut-off procedures. Then verify that subsequent payments to creditors are not double recorded in January 2023. Verify that subsequent payments to editors are not double recorded in January 2023. So if you are carrying out procedures, anything related to bank or to bank, then don't forget confirmation with the bank. Don't forget bank reconciliation, because these are controls. Now that is Roman 1. Roman 2, discuss the propriety or otherwise of reversing the indicated amount of outstanding checks as at 31st December 2022. That's what we read in the third paragraph. The client wishes to adjust the cash balance and accounts payable as at 31st December 2022 by 27.6 million. The client remedied informs you that unmailed checks amounting to 7.6 million were on hand as 31st December 2022. They were unpaid 31st December 2022. He said that this December 2022 dated checks had been entered in the cash disbursements book and charged to the respective creditors in December because the checks were pre-numbered. You see that? When you go back a bit, we read that you discovered that the client had been drawing checks as the creditors' invoices became due, but not necessarily mailing them. So the checks had been drawn, but they had not been mailed. That means that the cash at bank ought to have reduced by 27.6 million, but it has not reduced because that money has not been withdrawn by the creditors. So the company would wish to reverse that. So you are to advise on the propriety or otherwise of reversing the indicated amount of outstanding checks as at 31st December 2022. What do you think? It's not appropriate. You've said reversing the checks is not appropriate. Can you give us the justification? So reversing the checks would misstate the financial position. The reason is reversing the checks would give a misleading, okay? It will be misleading, will misstate the financial position. Let me use the word misstate. Would misstate the financial position of the company. It would understate accounts payable. It would understate accounts payable and overstate the cash balance. That also violates accounting principles. It violates accounting principles. How does it violate accounting principles? It would not accurately reflect the economic substance of the transactions. The economic substance of the transaction will not be stated, and that would potentially mislead users. That would mislead users of the financial statements. Reversing the checks would mislead users of the financial statements. It would provide a misleading picture of the company's financial health. So that is how you earn the 3 marks. Now, if you are to be asked the right approach, what would be the right approach? What should the company do? Disclose, candidates. The company should just disclose. What should be disclosed here? Disclose the outstanding checks. The company should disclose the accounting checks. It should disclose the existence of the outstanding checks in the notes to the financial statements, or even just classify the checks as current liability. They should be classified as current liability. The checks should be classified as accounts payable or just current liability. Then follow up to ensure that the checks have been cleared by the bank, or the checks were issued before the auditor arrived. Do you see that? So that's it for this question. Any question? Do you have any question? So thank you for attending the lesson. Hope to meet you in our next session. Bye bye.
Hi candidates, welcome to another session of Manifested Online Classes. So in this session, I want us we continue with the topic on impairment of asset. So in our previous class, we discussed or we defined what is an impairment. When an asset is deemed to be impaired, those particular factors which shows that the asset could be impaired. And also we did an illustration question as far as the determination of impairment loss is concerned. So in this session, I want us to look on what is a cash generating unit in accordance with IS 36, and how do we determine the impairment loss of a cash generating unit, and how is such impairment loss allocated to those particular assets within a cash generating asset. So first of all, we'll talk about cash generating unit, which is abbreviated as CGU. This refers to a group of assets which generate cash flow as a group. Basically, what that means is that if you pick one of the assets from that particular group of assets, that asset cannot be able to generate cash flow on its own. A good example is something like a factory. So a factory, we know, do have a number of assets. We have the factory building. We have the machines which are installed within the factory. We also have computers maybe for record keeping. We also have some tractors which work in the factory for transporting the raw materials maybe from point A to point B and so on. So therefore, a factory is basically a cash generating unit. It's basically a group of assets which generate cash flow as what? As a group. What that means, therefore, is that if you pick one of the assets from that particular group, it cannot be able to generate cash flow on its what? On its own. As we are going to see later on, in determining now the impairment loss of a cash generating unit, we determine the impairment loss of the entire group of assets and not the impairment loss of the asset within what? Within that particular CGU. But before we do that, let's first of all define what is a cash generating unit or a CGU, And I've said that this is a smallest identifiable group of assets, assets that generate cash flows, that are largely independent from cash flows generated by other assets, or group of assets, So that is the definition of a cash generating unit. Now, what you have said is that when it comes to determining the impairment loss of this particular cash generating unit, we have said that we determine the impairment loss of the cash generating asset, not the impairment loss of individual asset within what? Such a group of asset, simply because you have said that this particular asset here, they generate cash flow as a group. And it is also important for you to recall, for you to be able to determine the impairment loss of an asset, there is something you need to determine or to compute known as the value in use. We compute the value in use or the recoverable amount of an asset using the cash flows which are generated by the asset. And due to the fact that individual assets do not generate cash flow on their own, it is not therefore possible to do what? To determine the impairment loss of individual asset within that group. But what you're saying, we determine the impairment loss of what? Of the entire cash generating asset. So therefore we can say that it is not possible to determine a recoverable amount of individual assets, within the cash generating unit. I've explained the reason why this is the case. We are saying if, for example, we have a group of assets, we can take, for example, a factory. Factory, we have said, comprises of a number of assets. We have the machines in that factory. We also have things like the patent. The patent is that innovation used by the company in terms of producing various products. We also have things like computer equipment. We also have things like what? Motor vehicles, which work within that factory and so on. So therefore, we are saying that this is a good example of what? A cash generating unit. So this particular asset here generate cash flow as a group, meaning that if, for example, you pick one asset from this particular group, like maybe you pick something like machines, these machines cannot be able to generate cash flow on their own. And therefore, it is not possible to determine the recoverable amount of that particular what? Machine. Because for you to determine the recoverable amount of the machine, there is something which you need, and that is the cash flows generated by that machine. We are saying the machine itself cannot or do not generate cash flow on its own. The cash flow which is generated, it is generated by all these particular assets as what? As a group. That's why we are saying it is not possible to determine what? The recoverable amount of individual asset within what? The cash generating what? Unit. So instead now what we do, we determine the recoverable amount of the cash generating unit, and further we go ahead and determine the impairment loss equally of the cash generating what? Unit. So therefore we can say thus the recoverable amount of the CGU is determined, which is then used in computing in computing impairment loss, computing impairment loss of the cash generating what? Unit. So therefore, once we have a group of assets which generate cash flow as a group, we are saying it is not possible for you to determine the impairment loss of individual asset here, but what you do, you determine the impairment loss of the group of assets. You determine the impairment loss of the cash generating unit. Now, once the impairment loss of this cash generating unit has been determined, and actually this impairment loss of a cash generating unit is determined in the same way, just like how we determine the impairment loss of individual asset. Maybe you can just remind ourselves about the or on how we compute the impairment loss. So the impairment loss is equal to the carrying amount minus the recoverable amount. The recoverable amount, and equally you have to recall that the recoverable amount here we said this is the higher over two values. Number one, the value in use, or number two, the net realizable value or fair value less cost to sell. So therefore, in terms of how we determine the impairment loss of cash generating unit, we use the same approach, the same formula for determining the impairment loss for individual what asset. Now, this particular impairment loss for the cash generating unit, then we are saying should be allocated to the asset within that particular cash generating unit. And in doing that particular allocation, in allocating the impairment loss, there is the order which is followed. So therefore, you can say the impairment loss for the CGU cash generating unit is allocated to the assets within the CGU in the following order. So number one, we allocate to those particular assets which are obviously impaired. Number one, to asset obviously impaired. Assets obviously impaired. And when talk about assets which are obviously impaired, these are assets which are damaged, asset damaged, or the assets which are destroyed, the assets which are destroyed. So basically what that means is that if the company decide to sell this particular cash generating unit, then that particular asset which is obviously impaired will not fetch any amount of money because it is damaged, or basically it is what? Destroyed. Number two, we allocate impairment loss to the goodwill in the cash generating unit or in the CGU. And number three, we allocate to other assets. To other assets on pro rata basis. I.e. based on the carrying amount, or the net book value. So any impairment loss now will be allocated to the other asset other than goodwill, other than those particular assets which are obviously impaired, and that should be done in accordance with the net book value. In this case, we have said to other assets on pro rata basis. It is also important here to know that when allocating this particular impairment loss, the value of the asset should not be reduced below the higher of these three values. Below the higher of three what? Values. So therefore we can say in allocating the impairment loss, in allocating impairment loss, the value of an asset should not be reduced below the higher of three values. Number one, 0. Number two, the net realizable value of the asset. And number three, the value in use if it is determinable. If it is what? Determinable. Remember, in this case, in determining the value in use of an asset, we use the cash flows. We use the cash flows. We discount the cash flows to be generated by such an asset. But we are saying asset which are within a CGU, asset which generate cash flow as a group, then it is not it is not possible to determine the cash flow generated by individual assets, because those are assets. They are generate cash flow as what? As a group. So individual asset cannot be able to generate cash flow on its what? Its own. And therefore, in most of the cases, it is not possible to determine its value in what? In use. So therefore, once you have allocated the impairment loss, then make sure that the value of the asset is not reducing below the higher of 0, net realizable value, or the value in what? In use. So therefore, that is what is important for you to know. You need to know what is a cash generating unit. How do we determine the impairment loss of the cash generating unit, and equally, how do we allocate that particular impairment loss to those particular assets within what? The cash generating unit. And basically, I've said that is the order which is followed. To the asset which have obviously impaired to the goodwill, and basically to the other what? Asset in that cash generating unit on a pro rata basis. So I want us to do an illustration as far as this is concerned. And the illustration question I want us to do is a question which was tested in the sitting of August of 2022. And then at the end of this lesson, I will give some assignment on the same. So let's look on that question. So this is a question for August of 2022. Question number 2A. So the question is, B Limited operate a factory as its sole cash generating unit. During the year which ended 30th of April 2022, there was an explosion in the factory which necessitated an impairment review. So basically what that means that at the end of the year 2022, there was some evidence which showed that this cash generating unit could be impaired, and therefore there was a need to carry out impairment review. So we are given the carrying amount of the factory asset, which were as follows. So we have goodwill, and the carrying amount was 2 million, patent 3.6 million, machine 4 million, computer equipment 8 million, premises 30 million. The total carrying amount is 47.6 million. Then we have some additional information. Number one, we are told an impairment review or an impairment review revealed a net selling price of shillings 19.2 million and a value in use of 31.2 for the factory. 2, half of the machine have been destroyed and have no resale value. Number 3, the patent have been superseded and are now considered valueless. And number 4, we are told the company follow the cost model as permitted by International Accounting Standard number 16, that is which deals with the PPE. So what that means that the property, plant and equipment which are owned by this company, they are accounted for using the cost model. Remember what you have said is that if the company is accounting for its assets using the cost model, then the full amount of impairment loss should be deducted from the value of the asset. should be deducted from the value of the asset. That is the implication or basically the importance of that particular point. So what you're required is to discuss with suitable calculations how any impairment loss in the cash generating unit CGU would be accounted for in accordance with what? International Accounting Standard number 36. So we are required to discuss with suitable calculations. So basically what you needed to say here is that this company, that is B Limited, will need to carry out impairment review, or basically we need to determine the impairment loss of this cash generating unit and then proceed to allocate it to the asset within that particular cash generating unit. And actually we have discussed on the order to be followed by the company in allocating that particular impairment what loss. So therefore before we can determine the impairment loss, we can say that on 30th of April 22, which is now the end of the year, B Limited must do what? Must carry out impairment review and any impairment loss should be allocated to the asset within the CGU, within the cash generating unit in the following order. In the following order, one, we have said impairment loss should be allocated to assets which are obviously impaired. Number two, we allocate to the goodwill within that cash generating unit. And finally, to other assets. Other assets on pro rata basis. On pro rata basis means that when allocating now the impairment loss to the other asset within the CGU, we allocate that particular impairment loss based on the net book value of the other assets. The net book value, remember, is the same with what? The carrying amount. That's the first thing you needed to say. And then from there, you proceed, you determine the impairment loss. For you to do that, you must have the formula of determining the impairment loss, which is the carrying amount minus recoverable amount. So we need to have these two values, carrying amount and the recoverable amount of the cash generating unit. So the carrying amount, remember, is the same with the net book value because the examiner may give you the net book value instead of the carrying amount. And we already given that amount under paragraph 2 of this cash generating unit, which is given as 47,600 million. So that figure is already given. Then we have that we need next to determine the recoverable amount. And the recoverable amount, we have said that this is taken to be the higher, or we take this to be the higher of two values. Number one, the value in use, of which the value in use is given in the additional information number 1. We are told the value in use was 200 million. 200 million shillings. 200 million. So we take that all Roman 2, the net realizable value. The net realizable value in other terms is the fair value less cost to to sell. And this is what in the additional information number 1 is given as the net selling price. The net selling what? Price. Because when talk about the net selling price, this is the amount now which the company will receive after selling the asset minus any cost which will be incurred by the company in selling that what? Asset. And this is given as 19,200 million. 19,200 million. So what we need to do, out of the two figures, we need to take the figure which is higher. Automatically, that will be that 1.2 million, and that will be the recoverable amount. So therefore, you can say our recoverable amount, is shillings 31,200 million. 200 million. So having this value here, having the recoverable amount and the carrying amount. So what we need to do is to determine whether our cash generating unit is impaired. Remember, generally we have said an asset or even a cash generating unit will be deemed to be impaired when the recoverable amount is less than the carrying amount. So in our case, we know the recoverable amount is 31,200 million. What about the carrying amount? It is 47,600 million. So we need to check, is our recoverable amount less? Is this less than that one? Yes, it is. If that is the case, then we say that our asset here is what? Is impaired. Not the asset, rather, our cash generating unit is what? Is impaired. And therefore, what we need to do, we need to proceed and we determine the impairment loss. The impairment loss, we use our formula up here. We take the carrying amount, which is 47,600 million, minus the recoverable amount, which we already have here, 31,200 million. So we get the difference here, which now will be what? Which will be the impairment loss. So we have 47,600 minus 31,200. Okay, we can take that again. 47,600 minus 31,200. So that will give us impairment loss of shillings 16,400 million. 400 million. So what we need to do now is to proceed and allocate this impairment loss to the asset within that particular cash generating unit. So we need to do the allocation of that impairment loss. So we have allocation of impairment loss. Allocation of impairment loss. So remember what we said is that in allocating this particular impairment loss, this is the order which we follow. 1, we allocate to those assets which are obviously impaired. Then we allocate to the goodwill. And finally, we allocate to the other asset based on their carrying amount. So there is some information which you are given in this particular question here. Let's go to the additional information number 2. We are told half of the machine have been destroyed and therefore they have no resale value. So any asset which do not have a resale value, such asset is obviously impaired. Because you have said assets which are obviously impaired are those assets which are destroyed, or basically those assets which are fully damaged. So therefore, number 1, we are going to allocate to machine. And basically not all the machine. We are told half of the machine. Half of the machine. And if you go back to the information we have under paragraph 2, the machine have a carrying amount of 4 million. 4 million. It is important to note that these figures here are in thousands of shillings. So therefore, these will not necessarily be millions. Yes, because our figures are in thousands of shillings. Yes, so let's do away with the million here. Yes, but we need to know all our figures here are in thousand of what? In thousand of shillings. In thousand of shillings. Yes. So first of all, you're going to allocate to the machines, not all the machines, but half. So machines, they have a value of 4 million. So what is half of 4 million? Half of 4 million is 2 million. So therefore, because those machines are fully impaired, we are going to allocate an impairment loss equivalent to their carrying amount, which is 2 million, such that once you have allocated that impairment loss of 2 million, we are going to reduce the carrying amount of 2 million with 2 million. And that means that the value of those machines after allocating the impairment loss will be zero. Will be what? Zero. So basically, it means that the other machines, and that is half of the other machines, or half of 4 million, those machines are not obviously impaired. So then there is also another information we have in note number 3, that patent, which is one of the assets within that CGU, have been superseded and are now considered valueless. So when talk about patent, a patent is basically an innovation which is used in the factory in terms of producing various products. So if you're told it is superseded, it means that it has been replaced by a new patent, and therefore it is considered to be valueless, meaning that such asset is also considered to be fully what? Impaired. So if the company decides to sell this CGU, that patent will not fetch any amount of money. So therefore, next we allocate to the other asset which is obviously impaired, and that is what? Patent. And in this case, we are going to allocate impairment loss of how much? That is 6. Remember, our total impairment loss is 16.4. So therefore, in allocating this impairment loss, always you must remember how much is the impairment loss. You can see to this machine, we have allocated impairment loss of 2 million. So meaning that out of the total impairment loss, we have an impairment loss which is remaining of 14.4. So we then allocate now an impairment loss to patent of how much? That is 6. Still, our impairment loss is remaining. Then we have allocated out to the assets which are obviously impaired. So these are assets obviously impaired. So next, we allocate now to the goodwill. Within that cash generating asset. So the value of goodwill is what? Is 2 million. Can we be able to allocate a full amount of 2 million? Yes, because remember our impairment loss 16.4. To the machine, we have allocated 2 million. To the patent, we have allocated what? That is 6. So mean that the remaining impairment loss is in excess of 10 million. So therefore, to the goodwill, we are going to allocate the full amount of what? 2 million. Yes, so that is goodwill. And then finally, we allocate now to the other asset within that CGU. So which are those other assets? We can just list them here. Other assets. These include, from the list which you have provided under paragraph 2, we have allocated to the goodwill, we have allocated impairment loss to the patent, and then we have now the machine. We can talk of the other machines. Remember, the machines which were fully impaired here were half. So the other machines will be having a net book value of what? A net book value of 2 million, or a carrying amount of 2 million. So and then below that, we have computer equipment. We have not allocated any impairment loss to those computer equipment. The net book value or carrying amount is what? Is 8. And then we have a premises. A premises whose value is 30. So mean that the total carrying amount of these 3 assets is what? Is 40. So why do we need this particular value here? We need that particular value because we are going to allocate now the remaining impairment loss to those 3 assets based on their carrying what? Based on their carrying amount. So therefore, what we need to do, we need to determine the impairment loss now to be allocated to these 3 assets. So how do we determine that? So the first thing we need to do is to determine how much impairment loss was allocated to machine, or the total impairment loss allocated to this machine which were destroyed, patent and what? And goodwill. And this will give us 4 million. Meaning that that will come to a total of 36 plus 4,000. That will come to a total of what? Of 70 6. So mean that the total impairment loss which is here to be allocated will be equal to the total impairment loss minus the impairment loss which has been allocated to these three assets, 76, and the remaining impairment loss will be what? Will be 800. So, or 8.8. So this impairment loss will be allocated to these three assets based on their net book value, based on their carrying amount. So to determine the amount to be allocated to other machines, we take its carrying amount, which is 2 million, all over the total impairment, all over the total carrying amount of the three assets, which is 40 million, times the impairment loss to be allocated to the three assets. We do the same for computer equipment, 8 million, all over the total impairment, all over the total carrying amount, 40 million, times 800, and finally to premises, 30 million, all over 40 million, times 800. So this will give us the impairment loss to be allocated to those three assets. So to the other machine, we have 2 out of 40 times 800, and that will give us for 40. Remember also these figures are in thousands of shillings. What about to computer equipment? We have 8 all over 40 times 88, and that will give us 1760. And then finally to what? To premises, 30 divided by 40 times 800. So which will give us 66. So that is now the impairment loss to be allocated to other machines, computer equipment, and the premises. So that is it. That basically what was required as far as that particular question was concerned. And basically by determining this particular impairment loss and then proceeding to allocate it now to these other assets, then by doing that, you could have gotten now the allocated 10 marks. So that brings us now to the end of that particular topic regarding the determination of impairment loss in accordance with the International Accounting Standard number 36. But before we end our class, I want to give some assignment. These are some questions from the past papers. Make sure you attempt those questions. We have 2 other questions on this. So the first question is for September 2021, question 5B. So this question was requiring the computation of impairment loss for 2 cash generating units. And then we have another question for December 2023, which is question number 1C. Question number 1C. So make sure you attempt those 2 questions. And equally, if you have a challenge in terms of answering those questions, I always usually encourage my students to acquire this revision partner. All those particular questions are here. The questions are here, and also the solutions for those particular questions are at the end of this particular book. So if you have a challenge in terms of answering those particular questions, make sure you get this revision partner, which is basically available at a very affordable rate. So therefore, we come to an end, or basically that is the end of that particular session. So see you in the next class as we look on the other subtopic. Number 2, we have ratio analysis. So when talk about the ratio analysis, as the name suggests, this is basically a tool of analyzing the financial statements and it involves computation of ratios. It involves computation of ratios, or this tool entails computation of what we refer to as the financial ratios. The financial ratios. What is a financial ratio? This is basically a relationship between two or more financial variables. For example, in this case, as a financial analyst, you can express the profit reported by the company, or maybe the net profit or the operating profit, as a percentage of the company's revenue. So whatever you get, which automatically will be a percentage, is a financial ratio, and basically it shows the relationship between the operating profit or the net profit with the company's what revenue. So therefore you can say financial ratios is the relationship ship between two or more financial variables, two or more financial variables. Financial variables are those items which are included in the income statement, items of revenue, expenses, asset, liabilities, or what? Equity. Now, we have various ways in terms of these particular ratios may be used by various users. So therefore, you can look on the uses of ratios. Or uses of financial ratios. And even before you look on these uses of the ratios, it is important here to note that we have around 5 categories of ratios which may be computed using the information in the income statement and the statement of financial position. We have the profitability ratios, liquidity ratios, efficiency or activity ratios. We also have the solvency or capital structure ratios and the investment ratio. So therefore, what we are going to do here, we are going to look on what is the uses of those 5 categories of ratios. So let's start by looking on the uses of the profitability ratios. Ratios. Now, these particular ratios here are used in terms of measuring the performance of the company's management, because in this case we say that if the company is performing well, then that is as a result of the good performance of what the company's what management. So therefore these ratios we can say they measures performance of company's management. If a company is performing well, we have said that will be as a result of the good performance of the management. If the company is not is performing poorly, that we can also say it is as a result of the performance of a company's management. Then we also have the other category of ratios, and that is liquidity ratios. So how do we use these particular ratios, or how are these particular ratios used? Liquidity ratios, these are ratios which are computed. We're going to look on various types of liquidity ratios, and they are used to do what? To measure the ability of the company to meet the short-term financial obligations as and when they fall due. These ratios are computed to determine whether the company will be in a position to pay the short-term debts as and when they fall what? Due. So therefore this one measures ability of a company to pay, or in other terms we can talk of to meet short-term financial obligations. So will a company be in a position to pay the short-term financial obligations as and when they fall due? Short-term financial obligations, basically we are talking of payment which are supposed to be made to the creditors and basically the other who suppliers. So the company will need to compute now the liquidity ratios. So then from there we have the other category of ratios. So number 3, we have the efficiency stroke activity ratios. And these ratios, on the other hand, are computed to determine how well or how efficient the company is using its assets or its resources to generate revenue, or basically to generate profit. So we can say the measures the efficiency basically efficiency, we are talking of how well the efficiency of a company in using its assets to generate a profit. How well is the company using its assets to generate what? Revenue. And then the other category of ratios is the solvency through capital structure ratios. Now, these ratios, on the other hand, are computed to determine the ability of the company to pay or to settle the long-term debts as and when they fall due. They measure the ability of a company, to meet long-term financial obligations. So these ratios are computed to determine whether the company will be in a position to do what? To pay the long-term financial obligations, e.g. the loans which have been acquired by the bank as and when those particular loans fall due. Then we have the last category of ratios, and that is the investment ratios. They are also known as the equity ratios. Now, these ratios are computed to help the shareholders of the company, or basically to help the equity shareholders of the company in terms of doing what? In terms of evaluating how well the investment in the company is performing. As a shareholder, once you invest there by buying shares, you want to know how well your investment is performing. So therefore, we can say the help equity shareholders to evaluate performance of the investment. Evaluate performance of the investment. So therefore, we have those as the 5 category of ratios, and basically the uses. Okay, so then from there we need to proceed and look on what are the limitations of ratios before we can look on the various ratios which are computed under each of these categories here. We can first of all look on what are the limitations, or what are some of the shortcomings of the ratio analysis. So let's look on the shortcomings. Limitations of ratios. And basically here we have various shortcomings. We have various limitations associated with the ratios. Number 1, we say that ratios are historical in nature. So historical in nature means what? It means that when a financial analyst is computing ratios are always computed based on the past data. And therefore, if the circumstances have changed, then those particular ratios cannot be used in terms of making what? Decisions about the future. That is one of the limitations. Number 2, we say ratios ignores the time value of money. value of money. Ignores time value of money. So ratios do not have any consideration as far as the time value of money is concerned. If the company, for example, acquired an asset some time back, like 3 years back, maybe at a cost of 2 million, when computing the ratios, we use that amount of 2 million. I will basically use that figure of 2 million. So despite now 2 million currently not having the same value as 3 years back. So the ratios here totally ignore the time value of of money. On the other hand, we say ratios also ignores inflation. Also ignores inflation. Ratios do not have any consideration